Thanks, Dan. Good afternoon. And thank you for the opportunity to provide the annual program review of the private equity asset class. I'd like to start with an overview of the structure of the presentation. I will begin with a few implementation highlights before moving into a discussion of the private equity asset class performance and the drivers of that performance, before concluding by touching on a few priority accomplishments and initiatives. On the next slide, slide 35, we lay out a few implementation highlights from this past year. These include, we have expanded our partnerships with existing, former, and in some cases, new managers. We've also had a disciplined expansion of our capital deployment with an explicit focus on increasing our overall cost efficiency and diversification. And we commenced our strategic planning process. On the next slide, slide 36, we give an overview of the private equity asset class performance. In any discussion of the private equity program performance, I believe there are two important principles to consider. The first is time. The goal of investing in the private equity asset class is to generate long-term capital appreciation. This leads us to focus on longer-term performance, and individual year performance tends to be less meaningful than the 5, 10, and 20-year performance. The second important principle is that of measurement points. There are a number of complexities in assessing private equity stemming from the fact that there is not an investable benchmark, as is common with the public asset classes. As a result, we engage multiple points of measurement, including performance relative to our policy benchmark, peer benchmarks, other asset classes, and absolute performance. If I could point your attention to the top chart, we lay out private equity program performance for the 20, 10, 5, 3, and 1-year time periods. To ground you in the numbers, private equity generated a 7.5% return over the past 20 years, 10.4% over the past 10 years, 6.6% over the past 5 years, 5.9% over the past 3 years, and negative 5.1% over the past year. As mentioned earlier, the 1-year performance is based on 3/31 valuations, a date which public equity valuations were near recent lows. Relative to the same information we shared last year, private equity performance has deteriorated on an absolute basis across all time periods. If you look at the bottom chart on this page, we lay out performance versus the policy benchmark. Here you will see the private equity performance exceeded the policy benchmark for all time periods. While we're working to position the private equity portfolio to durably outperform the policy benchmark over time, the outperformance seen here is unlikely to prove durable in the near term, stemming largely from the timing of the measurement period. On the next page, slide 37, we have laid out CalPERS private equity performance relative to peer benchmarks, both Cambridge and State Street. I would note that these returns are presented on an internal rate of return basis, which is consistent with how these peer benchmarks are reported. Here you can see CalPERS private equity program has underperformed peer benchmarks across all time periods, in many cases by substantial margins. I believe the private equity program's performance raises a few important questions. First is, has the private equity program added value to the total fund over time? I believe the answer to that question is categorically yes. Private equity has outperformed CalPERS' other asset classes over the longer term, and in doing so, has generated billions of dollars in additional returns as a result of our investments. Without private equity's contribution to the total fund over the past decades, we would have lower aggregate returns today. I believe, however, there is a second important question that we need to ask ourselves, and that is, has the CalPERS private equity program performed at or near its potential? I believe the answer to that question is that it has not. There are a number of complexities and nuances in answering this question, but a few significant drivers of underperformance over time stand out. Those are, 1, a lack of consistent capital deployment. 2, a lack of strategic consistency. 3, a lack of diversification. And 4, a lack of cost efficiency. We understand the reasons for the private equity program's underperformance and believe these drivers are reversible over time. So how do we move the private equity program closer to achieving its potential? First and foremost, we focus on our people. Active and thoughtful engagement and alignment from the board, through CalPERS senior leadership, through the investment office, and the private equity team are critical to our success. We have an incredibly talented and dedicated private equity team, and I feel very fortunate to have the opportunity to work with such a committed, purpose-driven, diverse, and high-integrity group of people. Continuously cultivating our talent and developing our team will remain a top priority. Second thing we need to focus on to move the program closer to its potential is consistency. Consistency is key, and this is critical in 2 ways. The first is consistent capital deployment. So historically, we've been highly inconsistent with our capital deployment, and the truth is that has hurt us. Consistent capital deployment does not guarantee success, but inconsistent capital deployment creates a self-imposed obstacle that is difficult to overcome. If we continue to deploy capital inconsistently, I would expect continued underperformance. The second point on consistency that's important is consistency in strategic direction. We have cycled through strategies with too great a frequency. We are progressing through a strategic planning process now to clarify our direction for the coming 5 to 10 years. We've already completed the first phase of this work. We are focused on a back-to-the-basics approach, deep partnerships with high-quality managers, ramping our co-investment program, and integrating data into all aspects of our program. The third area we're focused on in moving the program closer to its potential is diversification. The private equity market has evolved materially over the past decade, and our portfolio has not kept pace. We will be focused on ensuring we have a diversified portfolio at the underlying investment strategy level moving forward. And the fourth area of focus is cost efficiency. Private equity is an expensive asset class. And in our case, this has been exacerbated by our historical implementation approach. We have the potential to meaningfully reduce the aggregate cost of the asset class while deepening our partnerships with our managers by scaling our co-investment program. We have begun this process and are seeing strong early traction working with our high conviction partners on this initiative. It would be difficult to understate the importance of our co-investment effort. By scaling our co-investment program, we have the potential to generate hundreds of millions, if not billions, in cost savings over the coming decades. So these are the factors you'll see the private equity program focused on in the coming years. We'll focus on our people, on consistency in both capital deployment and strategic direction, thoughtful diversification, and cost efficiency. On the next 2 slides, and we can flip to slide 38 now, we've laid out our priority accomplishments and initiatives. And I'd like to spend a couple minutes touching on a few of these before wrapping up. On our priority accomplishments, this year we reinitiated our internship program. This required significant effort across the investment office, but even in the short period of time we had our interns join us this summer, we've seen the benefits. Our interns brought in energy, enthusiasm, and set of insights that were a wonderful addition to our program. And we look forward to continuing and perhaps even expanding this program in the years to come. On the next slide, we touch on our priority initiatives. here, one I'll touch on is our strategic planning process. We are soon commencing the second and final phase of that work. We view this as critical to firmly establishing our approach, and we look forward to sharing our findings with you. And lastly, we will seek to continuously deepen our focus and integration of ESG and diversity and inclusion factors into our program. On ESG, we have deepened our dialogue with our partners, and we have seen ESG integration into investment processes in very encouraging ways, with many examples of it becoming a core part of our partners' underwriting processes, not only in ESG-specific funds, but across their broader underwriting. We are also focused on diversity and inclusion factors, both internally as well as with our partners. We are fortunate to have a diverse team, and I'm very grateful to Sarah Core and the other leaders of the program before her who helped build such a robust foundation. We view this as a constant evolution, and we look forward to continuing to improve on these dimensions in the months and years to come. Thank you for the opportunity to share this overview of the private equity program with you this afternoon, and I'm happy to take any questions.
Greg, thank you very much for this informative update. And I also wanted to thank Sarah, since she's switched positions, for her hard work through all the years on private equity as well. I just wanted to, I really am very impressed with how you want to build this out. I want to make a statement on that, but with the increased cost efficiency, were you talking about, like, maybe since we're going to be more consistent, does that mean we can get better transaction fees, management fees than we were getting?
Yeah, that's a very good question. So I think the two go hand in hand. So the one major lever for us having increasing the overall cost efficiency of our program is ramping our co-investment program. For us to be a reliable co-investing partner, we need to be consistent with how we deploy our capital, both to funds and to co-investing. You know, one dynamic at play with co-investment is more people would like co-investment than co-investment exists. And so our partners are in a position where they can choose to allocate co-investment among their LPs. So consistency and kind of having a deep partnership approach with our GPs is critical to us securing co-investment over time, which will help us lower the overall cost of the program.
Great. And then, so I just wanted to say also, as we move forward with private equity to achieve our 7% return, I don't think it's a secret, as a labor person, private equity isn't my favorite asset class. So when you talk about restructuring internal processes to improve underwriting and monitoring, and then you also talked about deeper focus on integration of ESG and D&I factors. So one of the problems that we have with private equity is the process where private equity buys into something and leverages it, and then ends up not paying their employees well or undermining their pension. So I just want to make sure that part of that ESG factor is that we're trying to take care of our human capital management, our labor, our workers. I think we're going to talk a little bit more about some of this in closed session, but it's important that we acknowledge that these things can end up being risk factors to us, whether it's reputational or monetary. I mean, if we look at what happened with Toys R Us, it was monetary and reputational. So I just want to make sure, as we're doing our underwriting, that we are taking these factors deeply into consideration as we buy into funds.
Yes, and in short, we are. You know, I think the folks, and by folks I mean the GPs who have durably created value over time, I think have been focused on these issues far before the discussion of ESG became more prominent, as we've seen in recent years. But ESG certainly captures the factors you're talking about, Madam Chair, with the governance and the social touching on human capital. And I think you'd be hard-pressed to find a manager who doesn't think that managing human capital and their own reputation are not critical to their own success.
I appreciate that, Greg. Sometimes I question that as we run into different situations and they get brought to our attention. So I'm hoping that we can come up with a better strategy of mitigating some of these problems that we get on the back end after we've been invested for 5 to 10 years already, so that we mitigate those in the future. I know as an asset class, it helps us achieve our 7% solution. So I know we have to be here. I wish we were 100% funded, and maybe we wouldn't, but I'm going to go on. I have 2 other questionnaires, and that is Stacey Oliveras first.
Thank you, Madam Chair. This question is from Mr. Ruiz. I want to get your thoughts on the adequacy of the benchmark that we have for private equity.
Yeah. I think in short, I'd say there's no easy answers for private equity benchmarking. There are, 2 broad, kind of very broad ways of doing it. One is to take some public market index and have a premium over that, and that's what we do. And the other is to use peer benchmarking. While our policy benchmark is a public index plus a premium, I'd share that we use all of these internally to look at our performance, and that's why we wanted to include both sets in the presentation today. So I think what you'll see from us is, because there is not an investable benchmark, you have a number of complexities, and rather than try and overly simplify those, we just engage on multiple points of measurement to try and see how our program is progressing through each different lens that those offer. I don't mean to equivocate here. I don't think there's any perfect answer, and I think the policy benchmark we're using is a very, very reasonable approach.
Would you say the difference in the benchmark, that our CalPERS benchmark is significantly different from Cambridge and State Street?
I just want to clarify your question. Is that, do I think that the benchmarks are sufficiently different?
No, statistically different, significantly different statistically. So if you look at the private equity indices, Cambridge and State Street, there's incredible variance between their indices and ours. And so I'm trying to reconcile that and whether or not we are using a benchmark that's appropriate.
Yeah. So your perception is absolutely correct. I mean, those benchmarks are quite different. So State Street and Cambridge are drawn from a peer universe. So they're looking at the performance of, peers of, broadly speaking, peers of CalPERS who are investing in private equity, whereas our policy benchmark is looking at a public index and adding a premium. Yeah, to me, what it boils down to a bit, and there are many other folks on our team that have a far more nuanced understanding of benchmarking than I do, but to me, what it boils down to is what's the aim? And so if the aim is to generate the highest possible returns in the asset class, I think there you might kind of drift more towards using peer benchmarks. If the aim is to generate attractive returns relative to your next best alternative, I think you may lean more towards using public indices plus a premium. And my sense is our aim is more the latter. And so I do think there's some consistency in our aim and our benchmark. But there, of course, are, there are many ways to approach it.
Maybe I'll just jump in quickly here.
Sure.
I'm sorry, Ms. Olivares. I'll just jump in. I'll say that, this is part of our migration towards thinking total fund, is, to Greg's point there, thinking through the fact that if the money's not sitting in private equity, it's probably in public equity. That's one of the reasons why we migrated to a total fund benchmark, to a public equity benchmark plus a premium for private equity. And I'll say, if you look at the history of our private equity benchmarking, and I think I mentioned this either the last meeting or the one before, that it's a real Frankenstein history. There's lots of things linked there, and some of those are pure benchmarks. And to Greg's very first comment, benchmarking in private assets, and this is as a public assets person, is inherently frustrating because there's not a good benchmark and it's not replicable the way that it is in the public markets. But I'll say that when we look at how we achieve success, this is Greg's point, that we look through lots of lenses. But when we look at whether, how we want to benchmark at a total fund level, and whether we know, because the alternative for us, if it's not in private equity, it's in public equity, we concluded that the best way to sort of drive that culture was to actually use a public markets plus a premium benchmark.
Yeah, I understand that. Thank you. What I guess I'm a little unclear on is the 150 bips too. So for Mr. Ruiz, what would you say the average total fee is for our private equity investments, all in?
Yeah, we have, let's see, I have it right here for you. So if we can jump to slide 88 of 88. No, sorry, 80, 81. So here we've laid out the fees that we pay, and I'd focus you in on the external management. So for the past fiscal year that just ended, we had total fees of 224 basis points. And that is a combination of both management and performance.
So if I'm looking at this mathematically, if we're looking at we go back all the way up to, what is it, slide 36? No. I'm trying to find it. Right, okay, so the cap weighted benchmark plus 150 bips, and our average fee exceeds 150 bips.
Mm-hmm.
Right, but bear in mind that what you're seeing on the screen is net return. So the returns that you're seeing in the private equity performance is actually already net of all the performance fees and carry.
It's pretty narrow, though.
Well, I think you're hitting on a really important point, which is given the costs associated with the asset class needs to deliver returns, net returns that or gross returns kind of in excess of what we could get, such that on a net return basis, we still see outperformance. So that is what you're putting your finger on is a constant headwind. And I think for us to continue to deploy to the asset class, we need to believe that on a net basis, we can still see outperformance.
Absolutely. And I think private equity is an important asset class. It's like, would you get rid of an entire food group, especially if you're a large institutional investor? And the answer is likely no. But I want to make sure that as we structure our benchmark and we look at our performance and the fees, that we perhaps take another look at how this appears, especially externally. I think it might create a little bit more confusion. Just food for thought.
Okay.
All right. Any other questions, Ms. Olivares?
No, thank you.
Thank you. So my next question is from, boy, I need new glasses. Margaret Brown. Ms. Brown? Okay, how about Ms. Paquin? I'm not hearing Ms. Brown.
Thank you, Madam Chair, and thank you so much for the presentation. I appreciated it. I was curious about the conversation around diversity and inclusion, and I was wondering what steps CalPERS has taken or could take to really work with our partners at their fund level and also in the portfolio company level to increase diversity and inclusion.
Yes, thank you for the question. So this has become, become a topic of much focus, but the importance has always been there. And I think what you're seeing from us now is a deeper set of dialogues with our partners, and we're leading some of those, and our partners are leading some of those. And we're seeing a focus on this across the private equity industry that I think is incredibly encouraging. And one aspect of private equity that I think is conducive to this is because our managers have a substantial, if not majority ownership position in the companies they invest in, we're actually seeing an ability for them to roll through some of these changes, even on an expedited basis, relative to what we're seeing in other parts of the market. So I think what you can expect from us, and in my comments I mentioned, I mean, I think it starts with us looking at ourselves internally, and I think we've done a good job there, but I think we constantly need to improve. Start looking there. It flows out to dialogues with our partners, and that flows into how companies are actually run.
Thank you. And are you working on this issue with other institutional investors as well?
So I guess what would you mean by that?
Well, I think that this has become a topic that other large investors, public investors, are looking at. And so I don't know if there's some kind of a movement to partner or to work together on this the way we do with other types of engagements.
Yeah, that's a really good question. I mean, what we do now is we're kind of active and constant dialogue with other kind of large peer institutions. We have not formalized anything specifically around this with those institutions, but I would say we're certainly seeing common efforts across all of us, and we're sharing knowledge between all of us. So I think it's a good point, and something we might want to give some thought to as to kind of if and when formalizing that could be a helpful step.
Thank you.
Thank you, Ms. Paquin. Mr. Rubalcaba, sorry about that.
Thank you, Ms. Chair. Mr. Rees, thank you for the presentation. I really enjoyed it. And I'm very satisfied to see your fifth point on page 39, the deeper focus on integration of ESG and D&I factors. And I'm glad my colleagues are raising questions regarding that. I had a question written down, but you'd sort of addressed it. I was going to ask how do you do that deeper integration? And you mentioned working with partner managers and also the underwriting process. So can you explain what is the underwriting process to ensure that there's deeper integration and focus on ESG and diversity and inclusion factors, please?
Yeah, I'd be happy to. And I think we're seeing this take place at two levels. So there is our underwriting process when we underwrite managers, and there we both solicit and receive information on their approach to these areas, and we bring that in, and as part of our assessment and our discussions. So that's kind of the one level. The other level we're seeing it take place at is at our managers themselves. So there we're seeing the integration of these factors the ESG factors into their underwriting processes. And for me, one of the most encouraging developments is the way we have seen this transition into the core business underwriting of a number of our partners. There was a time when these may have been discussed only with ESG-specific funds. And while that market segment has seen significant growth, it's still relatively modest compared to the broader private equity market. But when we see the integration of ESG factors into the underwriting of our partners' core businesses, it actually, to me, is showing that there will be a much bigger impact, because that's overwhelmingly where the dollars in the industry reside.
Thank you. And I also was it was good to hear the chair talk about human capital, and you mentioned in the affirmative that that's something you look at. I also want to take this time, since it's the first time I asked a question, to thank you and also Ben and all the staff for keeping focus during this uncertain market situation by COVID, and doing what you have to do, and protecting the liquidity, and also I like the word somebody said, taking advantage of this dislocations of the market. So thank you. Thank you, Ms. Chair.
Thank you, Mr. Rubalcaba.
Thank you, Ramon. And thanks for being patient. Sorry about that. My next person is, hold on a second. I lost everybody now. Did Margaret want to ask a question, or were you just letting me know I missed Ramon? If not, it looks like I've got, oh, Margaret, you did have a question. Margaret? You there?
You're muted, Margaret. No.
No, she can't get in? Margaret, you want to work with somebody to get you in, or send us your question via the chat?
Yeah, Ms. Taylor, she just gave us a thumbs up for that. She'll work with getting access.
Okay, good. So then it looks like I don't have any additional questions, but let's make sure that whatever Margaret's question is, Dan, I'll get it to you. And Greg.
Great, thank you. And with that, if we're done with question, I think we're ready to move on to real assets and Sarah Core. So Sarah, over to you.
The dog chewed her cable, just FYI. That's hilarious. I'm sorry, Margaret.
All right. Can everyone hear me?
Yes.
All right. Good afternoon, investment committee members, Sarah Core, Real Assets, MID. Before I get started, I would like to thank the entire Real Assets team for their support of me during my onboarding process. There's been a lot to learn, and they have been very patient with me. As I sit here before you, I want to emphasize that the preparation of this presentation was a total team effort, not just from the Real Assets unit, but also from many areas of the investment office. It's another example of the one-team approach we've been talking about today. In the last year's annual program review, my predecessor, Paul Machaka, commented that he did not know when the next downturn would come, but that it would. He stated that being consistent and disciplined would be important if Real Assets were to continue to provide stable cash yield and inflation protection, roles that Real Assets performs for Total Fund. As I sit here before you in these uncertain times, he could not have been more correct. It is too early in this cycle to know the true impact of COVID on the real estate and infrastructure programs. However, if we made a consistent deployment pace and strong governance, remain disciplined in our underwriting and internal monitoring protocols, the Real Assets portfolio, which has transitioned to being predominantly core, should be positioned to weather the storm and continue to provide stable income to the system. Next slide, please. Looking at the past year, the Real Assets team had a productive year with a continued focus on acquiring core assets. CalPERS managers made acquisitions during the period totaling $3.6 billion of equity. Over 95% consisted of core assets. Through the continued use of the annual investment process for separate accounts, staff has been able to better align the focus of the managers with CalPERS' desired exposures. Further, the real asset staff continues to benefit from the skills resident in other areas of the investment office, whether it is market perspective from global fixed income, hedging guidance from ESS, or research insight from RSG. This is not to say that real assets have not faced challenge. COVID-19 has had a negative impact on certain infrastructure and real estate sectors, namely transportation and retail. It is too early to tell how protracted and deep the impact will be. However, staff continues to be in close contact with their managers and is closely monitoring the situation. Next slide, please. While the portfolio continues to experience performance challenges, it has met an important role of providing stable income to the total fund. Over the past 5 years, the portfolio has provided income of 3.5% to 4%. Although longer term, the portfolio has underperformed the benchmark, it has exceeded the expected return of the asset class adopted as part of the last ALM process. Additionally, the core real estate portfolio, which represents over 70% of real assets, did exceed the benchmark in the 1, 3, 5, and 10-year periods. Conversely, the non-strategic portfolio continues to be a drag on performance. Infrastructure continues to provide attractive returns in the portfolio. The underperformance in the 1 year is due to older commingled funds and the impact of COVID-19 on infrastructure transportation assets. Next slide, please.
Lou?
Priorities in 2019-2020 remain similar to previous years. Staff's consistent focus on core exposures has successfully moved real assets from 56% core in 2015 to the current exposure of 85%. Staff continues to guide managers to improve the quality of the portfolio and so of non-strategic holdings. This repositioning should serve the portfolio well during the current market environment. In order to help increase exposure to infrastructure, the team has been focused on expanding the business model. Activities included forming new and refining existing separate accounts, as well as committing to infrastructure funds with top-tier managers. The manager alignment model used in real assets has provided staff with the transparency required to monitor the impact of COVID in real time. Next slide, please. Focus in the current year will be the development of a 5-year strategic plan. The emphasis on core assets has served the total fund well and is unlikely to change with the new strategic plan. However, as part of the ALM process, staff will collaborate with RSG and TLPM on the role of real assets. The output of that process will be incorporated into the strategic plan as needed. Staff continues to reposition the portfolio. Efforts here include diversifying the portfolio with the goal of decreasing exposure to retail and non-strategic holdings and increasing exposure to infrastructure, including renewables. Real asset staff has embraced and continues to focus on the INVO vision of one team with a culture of respect, trust, and accountability. In closing, I would like to underscore how important maintaining a disciplined and consistent approach is to delivering long-term returns. We have seen the negative outcome that can happen when we do not. If we stay the course, continue to focus on governance, and maintain measured deployment, real assets should be able to contribute to the investment office mission, which is to generate returns to sustainably pay benefits. Doing so will require the support of the One Fund team and you, the board. With that, I'd be prepared to take questions.
Thank you, Sarah, for the presentation. And you know what? I forgot to ask Greg, but I also want to ask you if you feel like you have enough resources. Do you have enough people? Do you have the resources you need to get to where you need to go for our 7% solution? So I guess I'll ask you, and I don't know if Greg's still available, but I wanted to make sure we ask that.
So within real assets, my current belief is that we do. That will be something I look at as part of the 5-year strategic planning process. But okay. From my initial read, I would say we do have enough staff.
Okay, great. Great. I just wanted to make sure, because I know as we move along with this whole new strategy, I want to make sure that it's well-resourced so we can all be successful. So I don't know, is Greg there? I meant to ask that earlier. That's okay. Dan, you can let me know.
I believe we do still have Greg. Greg, are you still are you still in the presenter room here?
I am. Yeah, so what you're seeing is we're evolving our strategy, and there's some things we've done for a long time that we're going to keep doing, and there's some things that we haven't done as much historically or at the same scale historically, like co-investment that we're going to be ramping. And so I'd say right now, I think our resources are appropriate for where we are right now. When I look forward, kind of 5 to 10 years, I would not be surprised if we wanted to add resources in targeted areas as we branched into and built bigger books of business around some of these areas we've discussed.
Okay, well, of course, and then we encourage you as you find this out to bring that to the board. We want to make sure that we're successful and we're doing this as a team effort. So that's what I wanted to make sure. But thank you.
Certainly appreciate the support.
Yeah, thank you, Ms. Taylor. And certainly we've had that support from the executive team as well, and we certainly see that support. And it's, as discussed, this is a CalPERS strategy, and I feel like we've got great support behind it. So thank you.
Certainly. All right. So the next question, it looks like Mr. Rublikava had a question. I don't know if it goes back to Greg or if it's for Sarah.
It's for Sarah, Ms. Chair. Can we go back to slide 41, please? Thank you. Ms. Core raised a couple times, you said that it's too early to know the impact of COVID-19. But I think one thing we've learned is the importance of having, back to the human capital again, the importance of having safe buildings. So the recovery is not going to happen if people can't go back to work. Tenants have to be safe. The workers have to be safe. As I was coming back into my building, they took my temperature and gave me a little sticker and everything. So I guess the point is we need to, for real estate to come back healthy, it's going to depend on the maintenance staff. It's going to depend on the security of the building. And so I just want to make sure that that's something we integrate into our real estate as we move forward, being cognizant of responsible contractor responsibilities and what have you. And I just want to make that point. I know you're transitioning to this role, and I appreciate that, but I just wanted to make that point. Thank you very much. More like a comment than a question, I guess. Thank you.
I can respond to that if you'd like.
Please,
within our office portfolio, the service workers, the security, cleaning crews that you mentioned, a very high percentage of them are actually unionized and SEIU members, and they are taking protocols not only to ensure the safety of the service employees, but that they're cleaning the offices where they do have information that somebody there was exposed to COVID. They're cleaning the offices where they do have information that somebody there was exposed to COVID very thoroughly, and they do clean all of the common areas every night. So they are taking good care of the buildings and of the service employees.
Thank you. Appreciate the update.
And
Thank you, Sarah.
For what it's worth, I'm sorry, Madam Chair, I was just going to mention that in November, we'll have an information item on our responsible contractor policy implementation. So we'll have another opportunity to hear from Ann Simpson and team about the overall responsible contractor policy.
Thank you for that. Looking forward to November meeting. Thank you.
Yeah, me too. Because I think I need to share that we have had some hundreds of deaths within SEIU members, not necessarily within our portfolio, but who are in janitorial and security. So it's just a concern that we make sure our workers are also taken care of so that we can open these businesses appropriately. And I have one more question from Margaret, but I also, Sarah, I had a question because I've heard this, and I think I asked it last time too, but I just wanted to ask about how we have some family units, right, in our real estate core, but we also have business units. So I'm not so much worried about the rent on the family apartments or whatever, but I'm hearing a lot of articles. I'm reading a lot of articles that are talking about businesses are now like, yeah, we're just going to telework from now on. So are we seeing that within our portfolio, people sort of pulling out of their leases and saying, yeah, we're just sending all our workers home? Is that going to become a new normal for real estate?
I think it's way too early to know what the long-term impact will be, if people will continue to work from home, if there'll be some working from home part-time, if the imprint needs to be larger because there's been a lot of compression in office space. So I think it's just too early to tell right now. There's some things that are definitely going to decrease demand and other things that could increase demand, and also where the growth in the economy comes from. So I think it's a little early yet.
Okay. Well, again, Sarah, thank you. Welcome to real estate. And I have one more question. Oh, no, I have two more questions now. Margaret, does your cord work?
Does it work?
Yes.
Oh, it's puppy. Darn. All right. Yeah, dog ate my homework. First time I've used that. Okay. I want to go back to page 37 of 88, and this is for Greg Ruiz back on private equity. And that's the table that has the peer universe benchmarks. And, I don't recall us seeing this before. And I'm just wondering if this is something new that you've come up with, or have we always done this and I just didn't notice how far off we were with our peers?
Yes, thank you for the question. We did not come up with this, but this is a method of benchmarking that exists and has existed for some time. I can speak for last year, and I know last year we did not include this information because this is not our policy benchmark. We included it this year as a way just to show kind of a broader set of measurement points for our performance.
Well, great. It's helpful to see, I have, as you probably recall, Greg, that I have consistently questioned the benchmark. I think it was before I got on the board, maybe 3 years ago, when the benchmark for private equity was sort of the mix of the assets was rearranged, and then the board took it from 300 basis points to 150 basis points, and so now we're able to basically stumble over the benchmark, and I think it's too low. And so I hope we will continue to look at this. I also appreciate my colleague Stacey Olivares' comments as well, but I think this is important to know. We are not getting there. We are not getting enough bang for those bucks. And, maybe it's fees, maybe it's other things, but maybe it's more co-investment. I know you're working hard on that, and I do appreciate seeing some of those SMAs come up, very, very nice. But keep up the work, and I really do appreciate if we could take another look at our private equity benchmarking. Thank you.
Thank you, Ms. Brown.
Thank you, Ms. Brown. It looks like Henry, Mr. George, go ahead.
Okay, thank you. Yeah, just the question back, I guess, is primarily related to private equity and real estate, but I know that it's the whole economy. But this whole issue of climate change, where we have fires in the West and we have the hurricanes and tornadoes in the South and Northeast, et cetera. Has those events created any renewed focus of companies looking at climate change as opposed? I know we've been very active in this space for a long time, and we've tried to encourage others to take it more seriously than they have. So the events that have occurred over the recent past, has that created any new discussion on climate change? Greg and Sarah.
Yeah, so this is Greg, and I'm happy to respond. I think what we're seeing is some of the recent and jarring events, I'd say, are increasing a dialogue that was already active, and are increasing a focus on a set of issues that were being considered in a number of our investors' underwriting cases. So I guess I would say I think it provides a strong tailwind to the deeper integration of ESG factors into underwriting.
Yeah, I guess I would answer it similarly. Clearly, there is impact to certain regions that have more exposure to climate impacts than others. But we don't have any specific investment guidelines or initiatives around that. We do look at our exposures by geography, but we haven't made any changes.
And Mr. Jones, one of the research projects that Ann Simpson and her team is working on is some zip code risk that they can start informing the decision-making processes that are happening both in real assets and private equity. I know that she'd be happy to give the board an update on that work as well.
Is that sufficient, Henry? Oh, you're on mute.
No, my request is that I would like to have Ms. Simpson provide an update if you can give that direction, Ms. Chair.
Yes, absolutely. We would like Ms. Simpson to give an update. Do you want it right now, or do you want to? I think we have it in closed session coming up.
Okay, I think.
Am I wrong, Marcy? I'm not sure.
Yeah, I think it would be appropriate for a public discussion of that as opposed to closed session.
Correct.
Be at the next meeting, but I mean, because I'm sure things will, the fires are probably not going to be out in a month, so
no,
it seemed to be accelerating. So it would probably be more intuitive even then at the next meeting. Okay.
I have read so much information that I have forgotten, but I just read about Ann's zip code thing on climate change, which will also help us identify climate change issues that focus on poverty areas where we know that's the case. And so I think that'll be really insightful. So if we can make sure Ann brings that up in the November meeting, that would be awesome.
Okay, thank you.
Yes, Madam Chair, I made a note that we'll add that. And for what it's worth, I'll also mention on private equity that Real Assets completed its carbon footprint this past year for the very first carbon footprint, and private equity will be completing theirs this year. So we can get an update on all of that from Ann at the November meeting.
Okay, thank you.
Thank you very much. It looks like that's all our questions. If we want to move on to, is that it? Are we done? Nope. Real Assets, my bad. Oh, we were in Real Assets. Oh, Margaret, did you have, Margaret, did you have another question that wasn't just for private equity? Did you have one for real assets also?
No, just I'm waiting for attachment 3. So we're not there.
Okay. So then we're done here.
All right, very quickly. I'll just conclude us really quickly, if that's all right.
Sure.
I really want to thank the team for all the hard work and preparation that went into providing this report today, as well as all the hard work that went throughout fiscal year 1920. Obviously, there was a number of accomplishments shared, and that work continues, of course, every day. I really hope that the new format, this kind of consolidation of the trust level review and annual asset class annual program reviews, really reflects our consistent evolution and progress towards our one team, one fund culture and perspective. Of course, it's a total fund that pays the benefits. We certainly seem to have lots of questions and engagement, which is really good due to the critical nature of this item. So thank you to you all for the time and thoughtfulness on this item. In summary, we did not reach our 7% return target. We're going to continue, obviously, to strive to do so. Our returns were positive in a very challenging market environment. We did beat our benchmark despite the market volatility. but we know that 7% is our North Star, so to speak, and that's what we'll continue to strive for despite navigating these challenging market conditions. We'll also continue to execute on the strategy of our 5-year strategic plan, enhancing our capabilities in private assets, looking to prudently and diligently apply leverage where it makes sense, and improving processes and utilizing technology, data, and good governance while keeping an eye on cost effectiveness. We'll continue developing our people, as we know this team is made up of people that will drive success not only now, but when the current leadership moves from being a team member to being a pensioners, frankly. And finally, most importantly, we'll keep a laser focus on investment performance, as that underlies our ability to pay the promised benefits to our nearly 2 million members. So unless we have any further questions, I think we can move on to item 6B. Madam Chair, do we have any last questions?
I had, I don't know if I have lost them. I had public comment on 6A from 3 people. Tari, do we still have that? Not hearing from anybody. Tari, are you checking?
Teresa, yeah. Teresa, we do have public comment.
Okay, so go ahead with the public comments. I think our first one in line was, I wrote it down, hold on. David Soros, is that correct?
That is correct, Madam Chair.
Okay, so go ahead.
Hello, this is David Stories with the Retired Public Employees Association of California. As you may remember, I'm a retired prosecutor, 32 years in Silicon Valley, and I'm directing my comments specifically at attachment 3 in agenda item 6A. The elephant in the room is, of course, the recent resignation of Chief Investment Officer Ben Meng. His, of course, specific reasons were health and family, but I think we all know that it was because a recent investigation of his conflicts of interest with Blackstone, a private equity partner of CalPERS. And so because of that, I think that we would all be very focused on reviewing CalPERS investments with Blackstone. Makita's report last June specifically referred to 24 Blackstone vehicles that CalPERS partners with, and specifically drew attention to Blackstone Capital Partners 8, which was the first Blackstone partnership that Mr. Meng entered into in March of 2019, soon after he came to CalPERS. And as he noted in his statements to the press, he actually had disclosed that he had conflicts of interest with Blackstone in his January 2019 appointment, Form 700. Well, I'm concerned because in reviewing attachment 3, that investment, Blackstone Capital Partners 8, is not included. And in fact, there are only approximately 18 Blackstone vehicles, including ones that they have taken that are under other names, listed in attachment 3, which is the equity program review. The billion-dollar investment that Mr. Meng entered into that was the ultimate cause of his resignation in March of 2020, Blackstone Core Partners 2, is not listed in attachment 3. And then finally, there's another significant Blackstone partnership, another $500 million that has already been committed. Okay, it's over $490 million in that, and that is also not in attachment 3. And one might ring this up to just somebody wasn't paying attention, except that we are all paying attention to Blackstone investments. And it's particularly troublesome because board president Henry Jones said to Bloomberg in an email that was reported in Bloomberg on August 16th that he was aware these problems when the CEO was aware.
Mr. Soares, I'm sorry, you exceeded your time, so we need to move on. You've exceeded your time.
That was 3 minutes, Ms. Taylor?
Yeah. Yeah, I let you go over too.
Well, thanks very much. I think I've made my point, which is you folks need to look at that report and see where these Blackstone investments are and why they're not being reported, because it's rather curious. I think some members of this board, at least, will agree. Thank you, Ms. Taylor.
Mr. Fox, next.
Yes, Madam Chair. Next in the queue is Robert Gerling from CSU.
Mr. Gerling, you have 3 minutes, starting when you start.
Can you hear me? Hello?
Yeah, we can hear you. You have some background, though.
Thank you for the excellent report that you've made by Dan and his team. I am also concerned about the point that was raised by President Jones, the issue of climate change. We in California are living with the dramatic impact of climate change, and investments in fossil fuel industry have been battered in the market. So I have a two-part question. Hello? The first part is, to what extent have CalPERS investments in fossil fuels exacerbated the volatility of the fund? And the second part is that the New York retirement system recently increased employer contributions due to the growing market volatility. Do you anticipate that we'll need to require increased employer contributions for PERS? So those are the two questions I had. Thank you for taking these.
So, Mr. Gerling, I'm wondering if I can ask to have staff get back to you with answers on that?
Yes, certainly.
Okay. So, Marcy, if you can make sure someone gets, thank you very much.
Okay.
And then, Mr. Fox, our next person, please.
Yes, Madam Chair. The next speaker is Mr. Al Darby of RPEA.
Committee members, Madam Chair, committee members, Al Darby, Vice President, Retired Public Employees Association. My issue relates to Mr. Begeson's presentation, his slide, I believe, number 14, Supplemental Income Plan Performance. In that plan, he indicates that the Russell, which is all of the stock market almost, outperformed, and that is U.S. stocks that are in the Russell, outperformed global equity, non-U.S. stocks, very dramatically over the past 5 years. 3 years ago, it was identified that the CalPERS equities portfolio, global equities, all equities were overweight in non-U.S. stocks. There is a dramatic difference between the performance of those two categories within our equities. And I'd like to know how many basis points each year we lost in the PERF by not having the fund being overweight in U.S. stocks as opposed to non-U.S. stocks. Ever since November 2016, the stock market has been going quite well, and at the present time is about 50% higher in the Dow than it was when Mr. Trump became president, and the NASDAQ is even double what it was. So U.S. stocks dramatically outperformed non-U.S. stocks over the past 5 years, and for 3 years we've known that the PERF is overweight the other way in non-U.S. stocks. I'd like to know the answer to why that condition still exists. Thank you.
Thank you, Mr. Darby. I'm wondering, Dan, if you wanted to weigh in on attachment 3 that Mr. Torres was talking about.
Sure, I'd be happy to, Madam Chair. As far as the, and Greg or Sarah can speak more deeply about this, frankly, but as far as the Blackstone commitment not showing on attachment 3 reflects capital that's actually deployed, net asset value type capital. In the case of Blackstone, we've committed to that deal, but we haven't yet seen any capital get drawn down yet, which is why there's currently no capital deployed.
Okay, well, that's a simple answer as to why it's not showing. And then as to Mr. Darby's question, I think that Mr. Darby, you certainly can, we'll direct Dan or some of the staff to get back to you on that question. But I think it's been talked about before. But in the meantime, let us move on to 6E.
Mr. Chair, I have a question on attachment 3.
Okay, go ahead, Ms. Brown. Did I miss you?
Yes.
I think I missed you. There you are.
Okay, that's all right. Dan, this is for you as well. And I mentioned this when I spoke, the first time I spoke about the names. I look at this list and I try and match it up to the CAFR because I have no life. I also try and match it up to other announcements when we publicly say what our investments have been, these partnerships. And so when I'm talking about the names, and it's important about the names, I look at Blackstone Management Partners 4, but that's not the name. We don't have, I don't know what that is, because we don't have a fund called Blackstone Management Partners Fund 4 or 5. I think we're getting confused on the names here. And I'm wondering where this list comes from. Does it come from the PARs? I mean, I look at the very bottom and it says that 3 different companies put this together. I think I read at the bottom somewhere that State Street Bank and our staff and another consultant puts this together. But I'm wondering how I just think we need to be very careful on the names because it's like your title, it has to be held in the correct name. And I think maybe we're getting a little mixed up on that.
Thank you, Ms. Brown. And to your point, I made a note of that when we talked about 5D, that we'll look at the consistency with a CAFR. We are certainly always trying to be as transparent as we possibly can, and that means avoiding confusion. So we'll take a look at that and see what we can do to have those be as consistent as possible.
Yeah, if different people are preparing the reports, they need to not use a shorthand version. The name is very important, as I realized when we invested in a 6, in a 7, and then a 7 LLP. You have all these letters and numbers, and they're very close, but they're different funds. And I just want to make sure so I can match it up. Thank you.
Okay, thank you. And Sheree, am I understanding you that we have 3 more callers? Is that correct?
That's correct.
Okay, Mr. Fox, go ahead.
Yes, Madam Chair, you have the next caller, J.J. Jelensik on private equity.
Okay, Mr. Jelensik, you have 3 minutes.
First, I'd like to thank whoever gave us the picture back on the website about 2:20. We finally were able to see the speakers again. But I noticed that the report on private equity failed to show cash flows. And that's important because the whole purpose is to generate cash to pay benefits. I don't know why it wasn't included. However, when it has been included in the past, it has shown that the GPs and related parties take about 40% of the cash flow, and it's cash flow that pays the bills. The investors have 100% of the risk. One of the state pension funds in Pennsylvania released a study over the life of its PE program and showed a similar amount of money to the general partners. So it's not that CalPERS has done a poor job, it's the nature of the asset and the management structure. So you really do need to start looking at the cash flow. One of the other issues that came up is the benchmark and the difficulty meeting the benchmark. I will just point out that we have a history. If we can't meet the benchmark, we lower the benchmark, and that will solve the problem. But you really do need to look at the cash flows. And again, thank you for whoever gave us the picture of the speaker back.
Thank you. Mr. Fox?
Madam Chair, the next two speakers are with the private equity stakeholder group. First up, Alyssa Giacchino.
Go ahead, Alyssa.
Hello, good afternoon, board and CalPERS staff. I want to give you an update on issues regarding asset manager private equity firm Leonard Green and Partners. As you know, Leonard Green owns safety net hospital chain Prospect Medical Holdings, which owns hospitals across the United States, including 6 here in California. Over the course of its ownership, the Leonard Green-led investor group has siphoned almost $670 million from the hospitals in fees and debt-funded dividends. Workers, Congress members, state legislators, community groups, and investors have all been raising concerns about Prospect Medical Holdings with Leonard Green for months, and yet Leonard Green has not taken the necessary steps to resolve the issues. Now problems at Prospect's hospitals are getting worse. In Rhode Island, the state's Attorney General and Department of Health have delayed their process to review Leonard Green's proposed exit from the company until they can investigate the dividends the Leonard Green-led group has extracted. In August, Rhode Island Treasurer Seth Magaziner wrote a letter to Leonard Green saying that its harmful management of Prospect hospitals have left already vulnerable communities with fewer healthcare resources, and that the Rhode Island State Investment Commission would not consider any future investments with Leonard Green. In Connecticut, Prospect convinced the city of Waterbury to give Prospect-owned Waterbury Hospital an almost 70% tax break in July. Just weeks later, Prospect outsourced Waterbury Hospital's entire IT department. You'll hear shortly, I hope, from one of the workers who lost his job. Leonard Green has used the fact that it's investing on behalf of pension funds to justify its rating of Prospect. As 6 members of Congress wrote in their July letter to Leonard Green, quote, using the pension funds of public employees and other first responders as a cover for the harmful actions Leonard Green has taken against these hospitals and healthcare workers is unacceptable and dishonest, unquote. CalPERS is one of Leonard Green's biggest investors and should not allow itself to be used as a reason to loot critical healthcare resources. Please follow the lead of Rhode Island Treasurer Magaziner and stand up to Leonard Green to protect these safety net hospitals and their workers. So we have several other speakers who are requesting to speak on this topic. It sounds like you listed one other, but I think there's a total of 4 of us, including myself, so 3 pending, but they may be somewhere else in the queue. So hopefully Kelly Fox and other staff can help make sure that we all get our comments in. Thank you so much.
Thank you.
Madam Chair, we only have one additional caller, just to let Alyssa know. The other 2 callers she referred to have not appeared in the call-in studio. So our next caller, Mr. Steve Schrigg.
CalPERS to help get a written community benefit. Hello? Should I start?
Yes, go ahead.
Go ahead.
Hello? Yeah. Good afternoon. I will speak to the impact of Leonard Green Waterbury Hospital's triple dipping. My name is Steve Schragg, and I'm with the Naugatuck Valley Project. And we need CalPERS to help get a written community benefits agreement with Waterbury Hospital and to get the 10 information technology workers their jobs back. We are dealing with a triple dipper here, and I'll explain why. DIP 1, Prospect Medical Waterbury Hospital properly received a 70% tax break from the city of Waterbury, valued at $22 million. When the CEO, Lester Schindel, discussed SARS-related financial losses as the reason to get the tax break, he did not disclose that the CARES money, federal CARES money, gave them $26 million for Waterbury Hospital alone. Waterbury city government claims that there has been a $6.5 million real estate improvements. However, they sold all the property for the hospital to an Alabama corporation. They claim that $16 million in capital improvements, but Prospect Medical promised $55 million in capital improvements. They claim $12 million in money given to the community. We have no signed agreement to make these resources to the community permanent, no transparency about where the money went. DIP number 2, Prospect Medical received federal money totaling $283 million, $45 million just for Waterbury Hospital. In addition, Connecticut Hospitals also asked the state for $450 million in July. Where is the money going? DIP number 3, Prospect Medical Leonard Green paid dividends and fees to themselves totaling $658 million. Where is the money going? The impact. Waterbury Hospital outsourced the 10 information technology jobs. An IT worker with 33 years experience was being paid $38 per hour with health care and a pension, was now offered $13.50 per hour, a 20% increase in health care premiums, and no employer contributions to their pension. Where is the money going? Here is the Waterbury Hospital Prospect Medical Leonard Green report card. Satisfactory character, failure, their refusal to negotiate a community benefits agreement. Competence, Committee on Joint Commission review for the hospital was found that they were not in good shape several times. Grade, failure. Continued access to quality health care. Through outsourcing, they endangered the IT department. The help desk, to help healthcare workers be able to use the computers they have, is now overseas and inadequate. Grade, failure. Continuing bonding by collective bargaining agreement. They ignored legal accessorship clause when they outsourced these IT department. Grade, failure. Triple dipping does not taste good to Waterbury. The Naugatuck Valley once had 40,000 jobs in the brass industry. They are all gone now due to corporations just like Prospect Medical Holdings and Leonard Green. This hospital is an anchor institution with the largest concentration of good jobs in our community. We have been struggling to get a signed community benefits agreement from for-profit hospitals for the last 10 years. For us to move forward, we need CalPERS to help rein in Prospect Medical Holdings, Leonard Green, to make sure that our hospital has the resources that it desperately needs for quality patient care and good jobs. Thank you.
Thank you. Are there any other people on the line, Mr. Fox?
Yeah, Madam Chair, we are screening one of the callers that Alyssa had referred to.
Okay.
As soon as we get them screened, I'll put them up.
Great, thank you.
Okay, Madam Chair, we have Eddie Gadomski.
All right, great, Mr. Gadomski. Go ahead.
My name, yes, is Ed Gadomski, and I've been employed at Waterbury Hospital for the past 32 years as a PC tech in the IT department. On August 3rd, 10 of us were called into a conference room and were blindsided and told that September 1st we would be terminated. Our positions were being outsourced to India. 3 of the 10 employees were analysts, and the other 7 employees were PC techs and help desk. We were told that we could reapply for our positions and would be offered comparable wages and benefits to what we currently have. As of September 1st, anyone calling the help desk is now speaking to a person physically located in India. Of the 7 PC techs terminated, 3 accepted offers from the company R4 because they had no choice to do so. 2 techs have underlying medical conditions, and the 3rd tech just bought a house, is married, and has 3 little girls at home. All 3 techs apparently fit the R4 budget as they accepted pay cuts to make a low to mid $20 per hour wage. The remaining 4 PC techs were all offered the exact same pay of $13.46 an hour with no counteroffer. In my case, that is about 1/3 of my salary after 32 years at the hospital. The 4 of us are now on unemployment during a national pandemic. In addition to the low pay rate offered, we are told we must find our own insurance. R4 is offering to pay 80% up to $800 for a family. A family insurance plan in Connecticut is about $2,000 per month. R4 also wanted us to go on call for free, then counteroffered with the $100 weekly premium, which is still a $650 weekly loss for our IT tech on call. We are also losing our pension donation as R4 will not contribute financially to any retirement plan. In my case, I'd be losing about $25,000 a year pay cut, and that is even before factoring in my $13.46 pay rate. The first week of September, the hospital has already hired another PC tech from the outside instead of recalling one of the 4 laid off PC techs. I wonder if the new tech is making $13.46 an hour. The PC techs are in a union contract that does have a successorship clause, which means the hospital cannot legally terminate us as they did, but they simply don't care. Arbitration could take weeks or months to win, but we cannot afford to be unemployed that long. We are asking for your help to please investigate this wrongful termination as our families have been greatly impacted. Thank you so much for your time and attention to this matter.
Mr. Fox, is there anyone else?
Yes, Madam Chair, we have one last caller, Mr. Dave Hannon.
All right, thank you. Mr. Hannon, go ahead.
Treasurer of Connecticut. Hi, my name is Dave Hannon, and I'm the Secretary Treasurer of Connecticut Healthcare Associates, District 1199, the union that represents registered nurses and technical employees at Waterbury Hospital, which was purchased by Prospect Medical Holdings in 2015. I'm going to give you 2 examples of the safety and staffing issues that my members deal with at Waterbury Hospital, issues that have increased exponentially during the pandemic and have been exacerbated by Prospect's one overriding concern, its bottom line. During the national shortage of personal protective equipment, my union forwarded Waterbury Hospital a list of vendors to purchase PPE from. After a few weeks of hearing that there continued to be shortages, I contacted the vendors myself to see what the holdup was. What they told me was both disheartening and unsurprising. The hospital was not going to purchase PPE from these vendors. Prospect wanted donations only. Later, we learned that Waterbury Hospital received nearly $50 million in PPP grants and forgivable loans, and another $17 million tax break from the city of Waterbury. That money seemingly did not go back into patient care. It went to prop up the hospital's profit margin. 3 weeks ago, a nurse who works in the family birthing center at Waterbury Hospital called me because she needed a test for COVID-19 after being exposed to by a coworker who had tested positive. The coworker had returned to work after a vacation out of state because Prospect requires staff to go without pay or use their own paid time off to self-quarantine, thus disincentivizing workers to stay home. To further compound the problem, Waterbury Hospital did not tell patients or staff that this employee had tested positive, potentially exposing hundreds of people for several days. My member tested positive herself and exposed her elderly grandmother and her partner, who both live with her. Her partner went to work and exposed 2 departments of the defense contractor he works for, which had to be shut down for 3 days to decontaminate. In the hospital, 3 additional coworkers tested positive, as well as several patients and newborns. There is no excuse for a hospital not to provide accurate contact tracing of and to its employees during a pandemic. Yet time and again, Prospect fails to do this because its razor-thin staffing model doesn't allow for multiple employees out at the same time, even during a crisis. Prospect simply refuses to spend the money it takes to provide safe, effective health care to its patients or to provide for a safe workplace for its employees. It is tempting to write off some of this as hard decision-making during uncertain times. That is a charitable view, and after nearly 6 years dealing with Prospect, I am not inclined to view them charitably. I feel strongly that CalPERS should work to disentangle its investments from Leonard Green and cease even indirect support of a healthcare provider that takes unnecessary risks with its patients and employees' lives for the sake of its finances. Thank you.
Thank you very much. And Mr. Fox, that was it?
Yes, Madam Chair, that was the last caller on item 6A.
All right. Thanks to all of our callers that commented on our 6A. I want to thank also the folks that brought up Leonard Green. As I stated before, these are some of the intrinsic problems with private equity that I feel like needs to really be addressed as we move forward with investing more of our money. Leonard Green is just an example of a few of these companies that have been brought to our attention, but it is always the workers that pay the price for us making our 7%. So I know we have to make that 7%, but I think it's also important that we figure out a way to make sure that our human capital management is taken care of when we invest in these companies. I think we're done. I'm sorry, I hit a button there. Done on 6A finally, so let's move on to 6B, which is our trust level review consultants reports.
Thank you, Madam Chair. Jared, if we could please move Tom Tote from Wilshire, and then also Christy Fields and Steve Hart from Makita into the presenters room, that would be great. And we can also move the presenters from the previous item from 6A. We can move Eric Baggeson, Greg Ruiz, Jean Sue, Lauren Rossborough-Watt, and Sarah Core, and Steve Carden back into the attendee room, please. And with that, as you'll recall, this is our, this is the consultants version of the trust level review and annual asset class program review. So I'll turn it over to Tom to lead us through for Wilshire. Tom, over to you.
Thanks, Dan. Good afternoon. Tom Toe with Wilshire Associates. Madam Chair and other members of the board, I appreciate the opportunity to discuss the market and the portfolio with you today. I don't want to shortchange important discussions, so my comments will focus on items to really complement the economic review that Ms. Rossborough-Watt provided earlier and the portfolio results that Mr. Baggeson and the rest of the team discussed. I'll try not to simply reiterate points that they covered already, and I'm happy to answer board questions on any item of interest as we go through this. After the portfolio discussion, we'll move into Wilshire's independent review of the investment programs before I turn it over to my colleagues from Makita. Let's start with Wilshire's asset class expectations on page 2 of 55 in item 6B. This is a particularly important topic as the investment committee thinks about asset class expectations for risk and return and how they might impact the strategic positioning of the portfolio and its ability to meet your return targets. To start, you can really think about expected total returns as a collection of risk premiums which sit on top of a risk-free rate of return. In this framework, the starting point of the risk-free rate has a really large impact on the expected total returns of riskier assets which the PERF invests in. And much like the period following the 2008 global financial crisis, today's investment environment begins with zero yields on cash and cash equivalents, driven by the swift central bank action during the pandemic. Unlike the post-GFC period, today's challenges are made considerably more difficult by the very compressed yield spreads between zero cash yields and the market yields priced into longer-dated, high-quality fixed income instruments. And this is a challenge that's further compounded by real concerns that the bond return pattern itself, and not just its final destination after our 10-year forecast horizon, may be changing in a way that alters the utility of the asset within the portfolio. And to put it simply, because of the low starting point, high-quality fixed income might not provide the same level of diversification against drawdowns of riskier assets as it has over the past 40 years. So turning to the specific asset assumptions that you see on this page, I'll start with our fixed income expectations, which are down meaningfully as of the end of June, with a core bond return expectation of 1.25%, compared to 2.85% to start the year and north of 3% 1 year ago. Our expectations for equity returns have also moderated given the sharp rally we've seen in Q2 this year after going through what was the fastest bear market in history in March. Wilshire's expectations for global stocks are a return of 6.5% annually over the 10-year forecast horizon. In comparison, our return expectations for private equity, while lower than historical experience on an absolute basis, do offer a premium versus public markets of 1.65%. Now, we're often asked the question of whether our outlook reflects either a bearish view on the economy or a belief that stocks are significantly overvalued. Now, while we utilize multiple forecasting models, which do take valuation into account, when you look at the current Wilshire assumption suite and the expected risk premium associated with U.S. equities over that of core bonds, it sits right now at about 4.75%. Historically speaking, that's a very reasonable risk premium, which suggests that based on our expectations, we expect investors to be fairly compensated over the 10-year forecast horizon for taking on equity exposure. It's really that level of short-term interest rates that impacts the absolute expectations to a greater extent. If we flip to the next page, page 3, you can see Wilshire's expected return for the CalPERS portfolio based on those assumptions I just walked through sits at 5.56% over the 10-year horizon and about 6.8% over the 30-year forecast horizon. The upcoming ALM cycle should provide substantial opportunity to evaluate the strategic structure of the portfolio, ask questions, and really stress test assumptions. It's clear that challenging 10-year horizon return expectations are going to require an analysis of alternative strategies or different portfolio construction techniques in order to have any probability of meeting your objectives. Earlier today, Ms. Middleton asked about the risk profile of PERF. And as you can see here, our estimated risk expectation sits at 11.6% today, which aligns well with what was discussed earlier, and again is a longer-term look at portfolio risk. And this sits well within what we see with other plan sponsors across our client base. So in answer to her question, the current risk profile of the portfolio is consistent with other plan sponsors. One last point I wanted to touch on in the risk contribution of the current portfolio, if we look at page 4 of the agenda item, the risk contribution for equities accounts for more than 80% of the total risk. So if you look at the bottom left-hand side and you add up the blue pie slice of the pie with the red slice of the pie, that's where you get to the more than 80% number. And that's pretty typical for institutional portfolios, which are dominated by that equity risk. Balancing risk contributions is another topic of discussion for the ALM cycle. The recent educational discussion regarding total fund leverage is one method of balancing risks across the total fund while maintaining a specified level of total return. And in fact, the board has been discussing the utilization of leverage in a portfolio context going back to a prior offsite in 2017 with presentations from Wilshire and other outside experts. We think continued discussion and analysis of that will be coming up during the ALM process, and we think that's going to be an incredibly important discussion as we look to set the longer-term strategic direction of the portfolio over the next couple of years. The balance of this presentation really starts to dive into portfolio performance and attribution, I think, Eric and the team earlier touched on that enough. In the interest of time, I'd like to just open it up for questions on performance, or if it pleases the committee, I'd like to just skip forward to the universe comparison as it relates to performance.
Mr. Toth, it does look like Mr. Jones.
Yeah, thank you, Madam Chair. Yeah, Mr. Todd, on your slide, page number 3, the previous slide, yes, and looking at this is expected return of 10 years and expected return of 30 years, and I know that, you know, we are a long-term investor and we do look out, you know, 30, 40, 50 years, but when we look at data, generally we say that the 10-year returns is 6.81, but if we look out 30 years, we've often been told that, well, we can get to 7 if we go out 30 years. And based on this particular chart, your expected return for 30 years is less than 7%. And so that creates, and I know we'll be discussing this at our ALM, but it does raises some serious issues that if we can't get to 7 in 30 years, then we have some very undesirable options. And so does this reflect the current profile of our investment strategy, or does this reflect any proposed changes going?
Thank you for the question, Mr. Jones. The answer is this reflects your current portfolio and the current market environment. So to one of your earlier comments that historically, as we've looked at this number, those 30-year expectations did tend to gravitate to 7+% expected levels of returns. But the interest rate environment has shifted so materially just in the last 9 months that has pushed the expectation lower because we're starting for the first 10-year period of that 30-year horizon with very muted expectations, and which gravitate to our what we call our longer-term equilibrium assumptions over time, and that's what's dragging that return down from what has historically, as you correctly stated, been 7+% down to what you see at that 6.8%. So from a portfolio strategy standpoint, I do think it's going to require looking at things that are, I'll say, new, and being cognizant of the potential benefits that those types of strategies can deliver, as well as the risks to the portfolio. I really liked one of the comments that Ms. Jean Sue made earlier, that we know there are additional risks with some of these alternative strategies, and investors need to take risks to be compensated by return, and ultimately that's the trade-off that we're looking to strike with the asset allocation.
Okay, well, we'll be looking for your comments at our asset liability management process.
We're looking forward to it.
Okay. Thank you.
Thank you, Mr. Jones. Ms. Middleton.
Thank you, Madam Chair. And Tom, thank you. This is going to be a continuation of some conversations we've had in the past. Private equity is certainly as Mr. Ruiz pointed out, something that is important, but is also underperformed. Could you give us your sense of the importance of private equity and private debt to our overall portfolio, and then I will follow up with a couple more questions.
I'd be happy to do that, Ms. Middleton. From a returns perspective, private assets are incredibly important. As we look across our asset assumption suite, and I could turn your attention back to page 2, and if you can just quickly run your eyes down the June 2020 column there for return, the only asset class on this page that returns more than 7% is in fact private equity at 8.15%. The traditional ballast in a portfolio, as I mentioned, core bonds at 1.25%, which isn't, it's helpful for liquidity purposes, for income purposes, and for that diversification, pulls you farther away from that 7%. So a bit of a long-winded way of saying, I think private assets, private equity, and private debt are one of the levers that the board can use to drive portfolio performance up towards that 7%. And being cognizant of the risks at the same time is going to be incredibly important.
And earlier today, Ms. Sue gave us some indications of the pacing of the ramp up in acquiring new commitments in private equity. Are you comfortable with the strategy that she outlined?
In short, yes. I'm comfortable both with the strategy that Ms. Sue laid out, as well as the one that Mr. Ruiz laid out on the equity side. I think it's incredibly important to be consistent with implementation on the private asset side, and that's one of Wilshire's key tenets for managing a private asset portfolio is consistent vintage year diversification, not trying to time the market or make oversized commitments one year and no commitments the next year. Much like for public assets, we think timing the market in that fashion is unlikely to be successful. So being consistent, I think, is very important, and that goes to the pacing, which both of them spoke to.
Great. We heard in public comment just recently from 4 employees of Waterbury Hospital, each one of them telling a story that is certainly very distressing. It's not the first time that we've heard stories of what appear to be very abusive labor practices on the part of private equity. Is there any direction or advice that you would have for an organization with the values that CalPERS has to ensure that as we move forward in this market, we can minimize our risk of partnering with organizations that have employment practices that are inconsistent with the values of CalPERS and inconsistent with the values of our members?
Thank you for the question. The short answer is yes. I do think it comes down to the diligence prior to implementation and a very solid understanding that with the partner, the private equity partner, that they understand those values that CalPERS brings to the table and expectations around the way they are likely to act. I'll refrain from making any specific comments about that situation as I'm not nearly well-versed enough, but I do think ultimately it comes down to implementation as it relates to private equity to make sure that the values with your partners align with those of the organization.
I thank you for that, and I will add the comment. I think that's something that is demanding of us, but it is something that we must do. Thank you.
Of course.
Thank you, Ms. Middleton. Ms. Olivares?
Thank you, Madam Chair. This is for Tom Toth. And looking at the report, it's a very robust report. Thank you. I know asset allocation variance and tracking errors have contributed to underperformance. Can you touch on how much of CalPERS' historical underperformance in private equity is attributable to our manager selection processes?
So I thank you for the question, Ms. Olivares. I would hesitate to try to put a number on it. As my understanding is that that staff has done that attribution, and so not to pass the buck, but I think they'd be better positioned to try to give you those numbers specifically.
Well, maybe not a specific number then, but I understand that the processes we use to select managers has changed over time, and as has our historical performance. And as we go forward in building out our private equity program, I want to make sure that our manager selection process is robust and equitable. So I'd like to get your opinion on our manager selection process in the past, and then what we're looking at going forward.
So I can comment in general about private equity based on the diligence process that plan sponsors that we are the private equity consultant go through for those. If I could, if we wanted to bring up the folks from Makita to talk about private equity due diligence specific to CalPERS, I think they'd be better able to provide some of that background. I think from my vantage point as the general consultant, one of the big changes has been looking to partner with those firms which provide co-investment opportunities as opposed to only fund opportunities in the past. And I don't remember the exact date on this. There's also been a push to try to consolidate the number of relationships across the private portfolio in order to drive both economies of scale and a deeper understanding of the investment process across those underlying providers. So those are two differences that come to mind over the last couple of years. But perhaps Makita or Mr. Ruiz could shed further light on that.
Okay, Stacy, do you mind if we wait until they do their report?
Yes, I wanted to hear Mr. Toth's perspective, and then we can hear Makita's.
Okay, great. Mr. Jones?
Yeah, thank you. Yeah, follow-up question, Tom. And I'm not talking about the specific strategies of private equity because we could wait for Makita for dialogue in that regard. But just looking back to your slide on page 3 again, I'm just looking at these numbers. And so you said this was based on our current portfolio. So does that mean that these numbers reflect the underweight in private equity now, which is down maybe 6.1 or 2%? And if the target allocation of, we were at 10 at one time, if we had our assets allocated to the 10% targeted level, would these numbers then be above 7%?
The numbers that you see on page 3, the actual allocation is reflective of your underweight, and the target allocation bar charts are fixed at your current target, which is 8% for private equity. To the extent you were to increase that to 10%, those numbers would move higher. I hesitate to try to do the math in my head. I'll likely only get myself in trouble, but that would, it would move that number by, let's say it's coming from private equity to from public equity to private equity, you would get a 2% times 1.65% additional return that would roll up to that total fund expectation.
Okay, and then therefore, the expected return in 30 years would be above 7.
I'm gonna, if you give me 1 second here, I will try to. I don't know that it would move it all the way there. I think it would certainly add somewhere between, I would say, 5 and 10 basis points to that expectation. So it would certainly get it closer, as it is a higher expected return asset class.
Okay, thank you.
Okay, thank you. We can move on now, Mr. Pong.
Great. If I could, I would like to skip ahead to attachment 4, which is the universe comparison.
I'm sorry, Ms. Taylor, I have one more question for.
Go ahead, Mr. Jones.
Yeah, and what about leverage? Would that help move this number up?
It would. And, that comes to how leverage is implemented in the portfolio, which is going to be critical. But generally speaking, the utilization of leverage would be able to move that number higher. But again, it comes down to implementation. Sure. You could utilize leverage on a lower risk portfolio and move it back to the same return, you could use leverage on this portfolio to move risk, to move both return and risk higher. So it really comes down to implementation. There's no, one answer for that.
Okay. All right. Thank you very much. Thank you, Ms. Taylor.
Sure. Go ahead now.
Okay. I just had a couple of comments on attachment 4, which is the universe comparison. I wanted to show graphically on page 2 of 14 the comparison of CalPERS results over the last year versus the universe. The earlier comments indicated that over the last year, it does rank in the top quartile for total fund returns. And you can see that here on the 1-year period, it ranks at the 19th percentile. Over the 3-year period, it ranks in the top 3rd. And apologies, I'm in attachment 4, page 2 of 14. I skipped ahead a couple of attachments just to make a quick comment. So this shows the comparison of CalPERS returns relative to other large plan sponsors through the end of your fiscal year. And that has shown some improvement. As you can see, the 10-year number sits a bit below median at the 56th percentile. And then one final.
Go ahead.
Sorry, one final comment here. We don't want to just focus on returns. We also want to focus on risk. On page 3 of 14 in attachment 4, you can see a risk return scatter plot relative to the universe, and you can see that the CalPERS risk level is also just below the median level of risk for this universe of plans, sitting at, we'll call that a little less than 10%. So the realized risk for the portfolio over the last 3 years has come in below median, whereas return has been a bit above median. So you, over the last 3 years, are plotting in that relatively attractive, more return, less risk quadrant on the scatter plot there on page 3. So you can see that in the upper left hand, the T would be the CalPERS perf plot. Any questions here, either on any of the comments that I made about the universe, or if there are other data points that you would like me to elaborate on?
It does not appear so you can move on.
Okay. So why don't we, we've touched on our total fund expectations, the importance of asset allocation. Staff earlier went over returns and attributions, so I'll move to our program reviews in attachment 3 for item 6B. Now, as a reminder, Wilshire evaluates CalPERS investment programs with a similar framework as we utilize when assessing other large asset managers. And so broadly, this includes a view around the investment organization and investment teams, the investment process, portfolio construction, risk management, implementation, and attribution. The review this year has been intentionally restructured to provide a more cohesive review of how each internal program fits into the whole total fund and combines to drive total fund returns. The scoring that you'll see in the appendix is done on a decile basis, with the first decile being the highest rating, a fifth decile indicating an average rating. And we also, for ease of use, correspond those to letter grades with first and second deciles. You could think about them as an A, third and fourth decile as a B, and so on down the line. As I said, the output of that evaluation for that scoring framework is included in the appendix. For the programs that we've done historically, we wanted to make sure we provided that so there's no loss of information or continuity from an oversight perspective. although we have combined what had previously been individual program reviews into one longer opinion letter here. Importantly, from an oversight perspective, there was no change in Wilshire's review process, which is meant to provide the board with an independent analysis of the strengths and risks present in the investment organization. The full CalPERS service team here at Wilshire was involved in virtual on-sites with senior Invo professionals across the research and strategy group, TLPM, global equity and fixed income, opportunistic strategies, and real assets. And these virtual on-sites this year were also supplemented with regular conference calls throughout the year to really understand the evolution of each team, any changes in portfolio construction, and a regular dialogue on specific performance drivers. My fellow team members are connected here today and if necessary, can be available to answer questions. As I mentioned, an assessment of the factors contributing to the stability of an organization and the alignment of incentives between the team and the organization's long-term objectives are really important components of Wilshire's review. And as such, this year's overall organization score is materially impacted by the recent resignation of the CIO. The search for a permanent CIO does introduce uncertainty and the potential for a shift in investment strategy and implementation, and it can't help but take up bandwidth from the organization. While we are familiar with and have a very high opinion of the interim professionals at the CIO and the deputy CIO level, that uncertainty has pushed us to lower our firm score from a C to a D, as senior team stability is not where we need it to be to score more highly. Now, while the departure of the CIO, as well as some pending senior level retirements, highlight instability for Invo staffing and give us pause, we also believe this is an opportunity to continue shaping Invo culturally and strategically to focus on total fund performance. Going through this period, it's very important to maintain a focus on investment belief number 4, with long-term value being driven by effective management of 3 forms of capital: financial, physical, and in this case, human capital. And number 10, that strong processes and teamwork and deep resources are needed to achieve CalPERS goals and objectives. During fiscal 2020, we saw continued evidence of a commitment to breaking down asset class silos within the team and focusing the discussion on improving total fund performance. We touched on some of those earlier. This includes centralizing the study of the strategic direction for the portfolio within the Research and Strategy Group, also known as RSG, which provides economic analysis and quantitative research, as you heard discussed earlier by staff. And this information is utilized by the senior investment staff to assess opportunities and align individual investment programs to support that total fund objective. RSG was instrumental in the investment strategy review, which evaluated all of the active risks taken in the total fund, which resulted in concentrating on those strategies where CalPERS believes it has a sustainable edge to drive out performance relative to policy, in alignment with investment belief number 7, taking risk where CalPERS will be rewarded, and number 8, that costs matter. As we've noted in the past and continue to believe, this total fund focus is very positive, as ultimately that's what's going to drive CalPERS' ability to meet its commitments to stakeholders. The balance of my comments here, and there's much more in the letter, are going to highlight overall scores and just 1 or 2 takeaways from each of the program evaluations. As I said, my colleagues are in attendance and they can comment on specific questions if necessary. But why don't I pause there to see if there are questions before I move on. Not hearing any.
I don't have any questions. We will have callers afterwards, so far.
Okay.
So move on.
Great.
Henry has a question. Yeah. You want me to go ahead, Teresa?
I'm sorry. Yeah, I thought I got you already.
Okay. Yeah, this is another question. It's on this looking at the evaluation scores and the overall organization firm with a D grade. And as you said, it's primarily driven by the departure of the CIO. And so how important it is to recognize that we continue to have a team of MIDs, we have a team of for private equity, we have an MID for real estate, et cetera, et cetera. And those individuals can continue to execute what the board policy has been, because the board has adopted policies for any CIO to follow, regardless of who that CIO may be. So how important it is that the board continues on that path, because we've adopted these policies. It wasn't the CIO that adopted the policies. How important it is for our acting CIO and our deputy acting CIO and our MIDs to continue implementing the policies that the board has previously approved in order to make sure that the ship is still moving forward.
Mr. Jones, to answer succinctly, it's extraordinarily important. The continuity of investment strategy and the depth that you had or have with the deputy CIO becoming the interim CIO and senior MIDs filling in an interim basis, and even more, I think more impressive is that the other investment professionals who have then stepped up in their roles goes a long way to instilling some confidence that the implementation of the currently adopted strategic policy can continue going forward. But we'd be remiss if we didn't, I'll say, call it as we see it. From a stability perspective, the CIO role is very important from a strategic leadership standpoint, from I'll say a thought leadership standpoint, driving a lot of that investment discussion and decision making. So I couldn't sit here and tell the board that the CIO's resignation doesn't have much of an impact. It's certainly mitigated by the favorable view we have on those who are sitting in those positions now. But having a strong, stable senior investment team, I think, is critical for long-term success.
Okay, thank you.
And
does that answer your question, Henry?
Yeah.
If just one other point on the total firm score, this has been a consistent discussion that we've had with the board over the years. Some of the other broader organizational issues relative to private sector asset management firms around ownership incentives are another reason that score ends up where it is, as CalPERS doesn't have the opportunity to provide equity ownership, or my asset management friends would chide me for this, but outsized performance compensation opportunities. And that's an important thing to keep in mind as well. What you'll notice as you look through the underlying individual programs is that, generally speaking, the team score is very robust. And that's where we reflect the strong depth of and quality of talent within the investment organization.
Thank you.
Mm-hmm.
Okay, Mr. Toth, go ahead.
Okay. We're going to start with TLPM, starting at kind of, I'll say, a high level. So utilizing Wilshire's standard scoring framework, our qualitative assessment places it in the fourth decile, which is the same as last year's review. The role of TLPM has changed a fair bit over the last fiscal year. The changes are detailed in the letter, but suffice to say that they've really focused on TLPM as the implementation agent for the strategic allocation set by the board. Other items like dynamic allocation, manager engagement, and analytics are not part of TLPM's purview, but have been assumed by other teams. And so with that decrease in scope, to focus on implementation, which includes the transition of some of the research to a separate centralized team, RSG, which I mentioned earlier, we'll work with you as the board and with staff to really determine best practices as it pertains to a formal review going forward. It might make sense to incorporate it into that firm score in the same way that we incorporate the impact of RSG, rather than looking at TLPM as a discrete entity. And I think that alignment would further support the move to focusing the discussion around total fund. Turning to global equity, our qualitative assessment places it in the third decile, which is a strong B. And while this is the same score as last year, it does reflect the same organizational score reduction as the other programs, as well as a slight reduction in the information gathering resources, which coincides with the elimination of many of the actively managed strategies across the portfolio. So our view is that because the global equity portfolio is not spending as much time trying to get an informational edge, we lowered that to be closer to average in our scoring. The change in the overall construction of the portfolio didn't change our scoring, as the portfolio portfolio construction was already highly rated, and we noted that in last year's review. So in summary, our view here hasn't changed, in that the global equity portfolio is a very efficient and cost-effective implementation to deliver the equity risk premium to the perf over time. Staff went over performance, but I'll reiterate that relative performance has been positive, and we look for that to continue going forward. Overall, that score reflects a strong and appropriately sized team that's in place and their success at managing the evolving portfolio in a very challenging environment in 2020. For global fixed income, our score there also placed GFI in the third decile, or the high B, which is, again, the same as last year, but the underlying components did shift. A similar reduction in organizational score. One of the risks I wanted to point out here was the size of the internal GFI team. It has declined, and we think that is a risk factor as we think about ensuring the continuity of the demonstrated investment success of the portfolio. It has occurred in the context of some movement of global fixed income staff to other internal groups like the RSG team. And while that's very good news for cooperation at the total fund level, it does detract somewhat from the dedicated global fixed income resources. So we're not ringing the alarm bells there, but we want staff to be cognizant of that. Now, these factors are positively offset by our continued high scores for the team, the portfolio construction and implementation. You saw the results, which really across the board were strong, if not very, very strong, particularly in the spread segment. And we think that the global fixed income program is managed effectively and in a very risk-conscious manner. It does leverage the deep experience and expertise of the senior management team across all of those sectors. And importantly, the investment approach is consistent with the key strategic objectives of providing income, stability, and a diversifier from equity risk at the total fund level. Moving on to opportunistic strategies. The opportunistic strategies is rated as a fourth decile, or I'll say a regular B rating. As we heard earlier, OS was established to invest in strategies that don't fit neatly into one specific asset class or type, but could possess characteristics that present relative value opportunities to enhance total fund performance. It is worth noting a couple of changes to the OS team worth highlighting. The execution services and strategy business line was moved from OS to the TLPM team, which reduced the OS team headcount from 23 to 8. But that expertise remains very present for the fund as a whole. In addition, we heard from the new MID for OS, and she has extensive experience investing in both enhanced beta and opportunistic investments. In terms of things to watch, and I think this dovetails with a lot of the discussion that we've had, with the departure of the CIO, it's going to be critical to examine and understand and monitor how the program is built out over time. We want to make sure that the OS team's efforts continue to be supported by broader INVO resources, particularly leveraging those insights from private equity and the global fixed income team. And I think that dovetails well with some earlier questions from both Mr. Jones and Ms. Middleton. And I think you can see in the answer to those questions that staff is cognizant of that risk and planning for the future. A couple of last points on opportunistic strategies. The oversight and governance of the OS program has continued to improve as we've codified staff authority limits, as well as broad allocation ranges to the underlying strategies. And Wilshire continues to participate in an oversight capacity to look at policy compliance, as well as benchmark alignment on a regular basis. So in closing for OS, we think the team is led by very talented staff. They are very focused on enhancing total fund performance by looking at asset classes which don't fit neatly in any one particular bucket.
Mr. Toth, I do have a question from Mr. Jones.
Yes, please.
Yeah, I think he answered my question. I was looking at the opportunity strategy, and I was looking at the area of resources, and I had raised that question earlier, and you kind of indicated that they still have access to resources as opposed to just the staff in that unit. And so, but as they begin to build out that particular strategy, and Mr. Ben Viennu said that he would come back and let the board know if they needed more resources. So that was going to be my question, but you answered it. Thank you.
Absolutely. So lastly, we turn to real assets before I turn it over to Makita. So Wilshire acts in a general oversight role for real assets to understand the impact of the program on total fund results. We provide oversight specifically related to forest land, but as you know, that's a portion of the portfolio that has decreased in size and impact, and we don't feel it warrants a separate evaluation. Our work in real assets involves regular discussions with the MID to try to understand the high-level investment initiatives and portfolio construction and performance attribution, and how risk is being managed in the portfolio. And this is meant to complement the oversight that's provided by the dedicated real estate and infrastructure board consultants who you'll hear from shortly. The team, as you heard, is focused on positioning the portfolio for the current challenging environment, while being cognizant to realize value where possible, which fulfills, in our view, the strategic role of the real assets program to provide stable cash flows, long-term inflation protection, and act as a diversifier for equity risk. With that, I know I went through a lot, and hopefully you found the opinion letter informative. I'd be happy to answer any more questions, or I can turn it over to the folks from Makita.
Chair Taylor, if I could ask a question to Mr. Toth.
Yeah, I just saw you there. Go ahead.
All right, thank you. So, Mr. Toth, thank you for walking the board and the rest of management through this framework. I think the way that this has been portrayed in the past when we've gotten these grades from Wilshire is that it's somehow a reflection of the investment performance of the investment office. So I do really very much appreciate the context and really trying to understand the frame by which you're doing the assessment. So one of the questions I have, because I know part of that framework is compensation. You did mention that the lack of equity exposure or equity access to employees in the system does have an impact on grades. So what is the highest grade that one of the teams could actually get? So fixed income did extremely well, beat benchmarks. Private equity or public equity did very well, exceeded benchmarks, low transaction costs. What's the highest grade they could get based on this framework about what's applicable to CalPERS and what is not?
Ms. Frost, that's a great question. I would say it would be challenging. So the best grade possible is that first decile ranking. A very, very good grade is a second or third decile ranking. Not to get too much into the weeds on the scoring framework, but it's meant to be a bell curve distribution with clustering around fourth, fifth, sixth, and gets incrementally harder and harder to move up the scale. So that's some broad context. With some of the broader organizations' compensation challenges, seeing the total firm score, I think there's room for improvement there, but I wouldn't expect that to get to that first decile ranking relative to private sector asset management firms. But certainly from a team perspective, I'm going to flip to the back to make sure I don't misstate anything. Across the board for the rating, they've got third and fourth decile ratings, which are quite good. I could see a second decile rating there. As let's say, I'll use as an example, opportunistic strategies as the dedicated resources there and the expertise that are brought in-house expand. That could increase that score over time. We try to take a thoughtful approach to adjusting these scores in the sense that we don't want to move from, let's say, fifth decile to second decile and then back down if, year by year by year. We want to see consistency. So we try to step up things slowly to the extent that it's warranted. And if there are large changes, then we are going to have to move things down. Ideally, the stability for the team kind of mitigates that. So a bit of a long-winded answer to your question, Ms. Frost, about what's kind of the highest rating that let's say one program could get to. I think if I had to ballpark it, second decile overall is probably the figure to focus on. You can see global equity and global fixed income are third decile programs currently. So you might see some marginal improvement there to push them into that second decile ranking.
All right, thank you.
Thank you, Ms. Frost. In addition, I now have Ms. Alder.
Thank you, Ms. Taylor. Mr. Toth, I'm going through the grading scale. I'm trying to make sure I understand how the deciles correspond with the letter grades. So it looks like A corresponds with the first and second decile, correct? And then B corresponds with deciles 3 and 4. And C corresponds with the fifth decile. What is the sixth decile also a C grade, or is that a D?
Fifth and sixth would both come in as Cs.
Okay, and seventh decile is a D. Is there enough?
Seventh and eighth would be Ds, and ninth and 10th would be Fs.
Got it. Okay, thank you. That's helpful. And then I had another question on opportunistic strategies. You mentioned some of the personnel changes we've had, and I'm grateful for the leadership we do have. we're relying on these strategies to bring us significant alpha so that we can meet the 7% return target. Do you feel that we have the ideal expertise and track record in-house now to carry this out? Or do you feel like additional resources are necessary?
Ms. Oliveris, I would say for the strategy as currently constructed, you have the right resources in place, but given the plan to build out that portfolio, that is going to require additional expertise and resources brought in-house to do it in a top-notch manner.
Thank you.
Okay, I think we can move on. I don't see any additional questions. I do have a caller on this. So, Mr. Fox, if you want to bring Mr. Woodson in. Mr. Fox. Oh, there we go.
Hey, Madam Chair, we're going to bring in Larry Woodson from California State Retirees.
Thank you. Mr. Woodson, go ahead.
Okay, thank you. Larry Woodson, California State Retirees. I hadn't intended to comment, and I actually tried to get in the queue when you were actually discussing it, so I'm going back to Mr. Koch's prior discussion on private equity, and I wanted to thank you, Chairman Taylor, and Board Member Middleton's comments regarding the being cautious about partnering with PE firms who have these kind of practices that we heard affected these four folks from Waterbury Hospital, which was a very poignant testimony. I wanted to give you, we've been aware of this problem for a while now, and I think I mentioned it in stakeholders, but I wanted to give you a bit of the larger picture. PE firms are now controlling hospitals, ERs, nursing homes, doctors' practices, particularly rural hospitals. And over the past decade, and these are some of the names, and you're all familiar with them, Blackstone, Apollo Global, Carlyle, KKR, Warburg Pincus, they've deployed more than $340 billion to buy healthcare-related operations around the world. And in 2019, they reached a record $79 billion of acquisitions. And so and just one other stat is Team Health is a subsidiary of Blackstone, and Envision Healthcare, owned by KKR. The two of them provide staffing for about a third of the country's emergency rooms. And by the way, they are one of the major causes of surprise medical bills around the country. And so I just ask that the board, of course, be aware of this, but perhaps direct staff to take a broader look at this issue, and the investment staff coordinate with Dr. Moll's health team and really take a look at where we may be inadvertently impacting not only employees of these healthcare providers, but own members and not getting the kind of healthcare they should be or being overcharged. So I thank you for your consideration.
Thank you, Mr. Woodson. Yes, something that I'm concerned about as well. It looks like that's it. So let's move on to, I guess, Makita at this point, correct?
Correct, Madam Chair. We have Steve Hart take us through private equity and real assets.
All right, thank you. I don't know who wants to go first.
I'm happy to start. Steve Hart from Makita. Can you hear me and see me? Very good. So I didn't want to take too long to go through, the report or have formal comments. I'll have a few here, but I wanted to be sure that we had enough time here, getting late in the day, to go through questions from the board. I think that, as highlighted by Mr. Ruiz earlier today, a couple of aspects about the private equity program that I wanted to touch on. So, number one, the the key issue that I've observed in terms of the private equity program, and we observed it when we first came on board a few years ago, is that the CalPERS remained underallocated to the private equity class, and just getting that exposure has been something that's been a development over time. And is in process, but does take a number of years to build up that program and that exposure. Second aspect, there's been a few questions on this today, and we can go for further questions kind of going forward. But the performance of the portfolio and how it has executed in terms of against benchmarks and overall performance has been a number of issues, and some of that is related to the way the exposure in this current program and portfolio has been developed over time. For instance, a lot of commitments in the early mid 2000s when it turns out that the returns were middling to poor, and relatively little exposure to the vintage years that were later on, starting sort of 2009 and going forward to just very recently. And so building that program over time that has quote unquote too much exposure over allocated to the poorer performing vintage years, and really less allocation to those that are turned out to be better performing. The issue is not so much whether or not one can know what their future performance is, but the fact that the exposure has been inconsistent has had a direct impact on how the performance is. The other comment I'd want to make is that if board would note that we have included peer benchmark information in our reports historically. So again, that is in there as well for the board's consideration. So we do think it's important to consider both what was called the proxy benchmark, the alternative to investing in private equity is public equity, as well as the peer benchmark to try to assess the program's performance against peers. A third aspect that is certainly underway in strong efforts by the staff relatively recently is really focused on the fees and costs, and using the list of opportunities that are available through co-investments to try to mitigate those costs and expenses. That had been a missing part of the program until just recently. It had stops and starts over the years. CalPERS had done that in the past, had made co-investments, but the strategy had not been executed consistently. It had been on and off. But that deployment of capital and execution and co-investments could have a pretty meaningful impact on the overall fees and costs. Next point is in terms of the exposure and diversification. I spoke briefly about one aspect of that, and that is the time exposure, vintage year exposures. As we've noted in prior reports, the portfolio is heavily tilted towards large and mega buyouts into those structures. Some of that is coming just from the size of the program and the requirement of a large amount of capital to be deployed every year, and the need to find those managers and strategies that can actually absorb that amount of capital. That being said, being able to think creatively and work creatively to find additional exposures to help diversify the portfolio has been important. And some of that has happened recently with the addition of these credit trigger funds to invest in stressed and distressed investments, as well as some secondary managers. In other words, managers that look to buy portfolios of typically private equity funds that another investor, limited partner, no longer wishes to hold. And sometimes that can be very opportunistic in getting some good values. And heretofore, CalPERS had really not explored or executed much in that strategy in a consistent way. Next point I would make is, and we can talk a little further on the ESG side of things, that as Mr. Ruiz noted, it is an increasingly important factor within the industry. And CalPERS has made that part of their diligence and monitoring for many years now, and remains an important focus. And I think, as Mr. Ruiz noted, I would agree with, it's been moving from a specialized area to being something that is thought about across the private equity asset class, the ESG and diversity initiatives. One thing I wanted to mention, while the opportunistic strategies is a way to think about the one fund and try to execute on opportunities that don't fit neatly within the asset classes within CalPERS. The Credit Trigger Fund is also an example of a one fund approach, and where being able to use the expertise and relationships that the CalPERS staff has in the private equity area to source and review opportunities that those private equity oriented managers are executing in a somewhat different asset class area than straight private equity. That's been a very thoughtful and well-timed approach, as it turns out, but an application of this one fund idea, and we're looking to try to use the talents within the organization to execute what's best for the overall organization. And then last point I'd make is in terms of the staffing, the formal numbers within the private equity group has been relatively stable. Mr. Ruiz has been in place for a year now. We do note that subsequent to the end of the fiscal year, Ms. Core had moved over to the real assets. The staffing, I think, is adequate for what they are doing now, but as there is increased execution, in particular on the co-investment side of things, it's going to take additional members, perhaps with some different skills, to be able to build that and work effectively. As Mr. Ruiz mentioned, he's working through a strategic plan, and this will be, an aspect of that, is thinking through how elements of the strategic plan impact different parts, and one of that is going to be on the staffing side. So I wanted to just do a quick overview here of these topics. A number of things are discussed a little bit more in our program review and performance letter that's attached for your assessment, but wanted to open up for questions to the board and otherwise.
Thank you, Stephen. Mr. Hart, sorry. It looks like I don't have any questions, but I sort of wanted to go through a couple of things that you talked about, which was the diversity. You need to be diversified to be a player in the market, and that it's continuing our relationships. And you and I had talked about this the other day. And I kind of want you to opine on the being consistent. I think Greg talked about it a little bit, but we, like you said, we were invested in the 2000s. We're no longer, we didn't have the cohort in the 2010s where it would have given us a little more money. So we haven't been a consistent investor in private equity. And if you could opine on why that's important and how that we're consistent and what that means for our returns and such a little bit.
Sure, I'd say there's a couple of aspects to it. One can look at industry data and see that the performance in different vintage years is obviously different, but that the performance in some vintage years is better than others, and that trying to time the market, especially in private equity, is nearly impossible. And knowing what the future performance is going to be, especially for these multi-year drawdown investment funds, is really impossible to do. So we strongly encourage our clients to develop a plan and try to, certainly without forcing capital out if there's no good opportunities, but to really work very very consistently within the marketplace to try to get that exposure in top quality managers. I think that what the team has been doing relatively recently is being able to work with, by being a consistent player in the marketplace, they can get more co-investment opportunities. They have this relationship and trust with the GP partners, but they can also work with those managers to create separate managed accounts that there's opportunity for fee savings. There can be opportunities to direct what asset classes and types of investments that can be part of CalPERS special separate managed account, be able to control some of those exposures. So by being a consistent player in the marketplace, it helps make sure that you have that consistent exposure to the asset class, and not without really knowing what the future is going to hold. But if you have that, you've got it. And then all the reputational benefits that you get by being seen as a consistent and trusted partner in the marketplace, to be able to get those co-investments, separate managed accounts, and things like that could bring a lot of benefits to CalPERS.
Thank you. So if we were to, there's been some talk about putting in a pause on this strategy, even though the board has pretty much adopted this strategy already, until certain things are finished. So basically what you're saying is that's probably not a good idea?
No, I would strongly encourage the CalPERS to be a consistent participant in the marketplace. You can see with hindsight, of course, but you can see that the performance of the portfolio has suffered from not participating in the marketplace in the 2010s through 2015 time period. And that's going to take a long time to roll through the portfolio. Because of that not participation, you're going to see that shortcoming of performance against peers is going to be reflected in there, and that's going to take a long time to roll out. So we really encourage clients to continue to be consistent participants in the asset class.
Okay, great. So then
Chair,
also I had...
Madam Chair, do you mind if I chime in on that really quickly? And I agree with everything Mr. Hart just said. I just wanted to comment on the potential for taking a pause. When I look at sort of the history and the lack of consistency within the plan, I see kind of three large effects. And this is as a, again, as a public equity person, and then thinking through the lens of the total fund. First of all, those pauses have caused us to be underallocated to this asset class. So not only has it hurt our relative returns within the asset class, but, Mr. Jones spoke about this, the fact that we're, low our allocation to the vintage years. So we are over-allocated to underperforming vintage years and under-allocated to overperforming vintage years. And that, too, has just been an effect of inconsistency. And this is the reason, in Mr. Hart's point, to continue that consistency. And then the third effect that I would say that you see is that we've been inconsistent in our commitment to co-investment. And that has caused us to not have been successful enough to average down our fee structures within the private equity asset class. But all three of those have been detrimental, and all three of those are as a result of really just being inconsistent in our approach to this asset class, which again underscores what Mr. Hart was saying. And then I guess the last comment that I would make, and Arnie's made this point several times, if we're not invested in private equity, we have to put it someplace, and the answer is we'll put it in public equity. And our return expectation for public equity, as demonstrated in our CMAs in the previous discussion, even our benchmarks, is 150 basis points lower in public equity relative to private equity. So every dollar that we don't invest in private equity is in public, and that implies a 150 basis point haircut over a long horizon. So I'm really glad you asked the question, and I did want to comment to that. So I'm sorry, Madam Chair, back to you.
No, absolutely. I appreciate that. And of course, if we get 150 basis point haircut, we pass that on to employers. So that's the last thing we need. And in response, Mr. Hart, you and I talked about this also, but in response to my concerns as a labor person with what we're hearing from Leonard Green and other private equity firms and how our labor folks have been treated, you and I talked about this, and something you opined on that. You talked about maybe we could do a best practices guideline, that it would be, if we've got relationships, that's a possibility.
Sure. So I know that, as I mentioned, ESG has been both an important area of analysis and thought within the CalPERS due diligence activities, as well as it being a increasingly adopted set of practices within the private equity industry itself. That going beyond the fact that the industry overall has moved very strongly to one of value creation rather than asset stripping and over leverage. That was more done in the 80s than what we're seeing today. So there's a lot of a lot of threads that are coming together to make that more and more effective. That being said, I would be happy to work with staff and to think within private equity. I know that Ms. Fields and Ms. Bacon could mention about, on the real asset side, about the responsible contractor policies and things that have been done within CalPERS on some of these areas. To maybe think about ways that could be some best practices to be thought within the CalPERS organization, and how to potentially work with some other large participants in the industry. Mr. Ruiz touched on that briefly in his comments as well, and to think about what would be an approach to some best practices and some evolution that could take place over time in this area.
Great. I would love that, Dan, if we could figure out a way to get together with Makita and put something together for that, so that we can, even if it's not co-investments and we're just an LP, is there a way we can do that? And I don't know, but and we can talk about that offline.
Noted. Thank you, Madam Chair.
Okay. I do have questions. See what happens when I ask too many questions? I'm sorry. Lisa Middleton, go ahead.
All right. Thank you, Madam Chair. Mr. Hart, thank you. If there's one word I've heard over and over and over today, it's the word consistency. And clearly, any honest review of our practices when it comes to private equity and private debt over the last 2 decades, consistent is not the description that would be given to our activities. So what specifically do you recommend we do and not do on a going forward basis to achieve the kind of consistency that we need in order to reach the benchmarks ultimately that are being achieved by other peer organizations?
Thank you for the question, Ms. Middleton. So I would say there's a couple of elements to that, to achieving the consistency. One is that until relatively recently, the way that the private equity group was given its allocation for how much new commitments it could make each year appeared relatively untransparent, and was not really, in my mind, one that I really fully understood. as to how the target was set for the amount of capital to be targeted to be deployed in any particular year. Some best practices in that area would be to have a pacing plan and to be able to think through with some assumptions of where the portfolio is today, some assumptions of where you would like to try to achieve in the longer time period, and some estimates about how the overall portfolio will perform and work. So using that is a pretty basic tool to set the framework around how much the staff should be considering to think about as an annual budget in order to ultimately reach a percentage allocation goal. I think a second one in terms of the consistency has to do with the strategy and that's approach. CalPERS has had a number of strategies over the years that with the overall aim of trying to achieve strong results for the program, but at the end of the day seem to be less effective. So when there was an approach to try to really restrict the number of managers that the private equity program would be able to allocate to, with the idea of trying to achieve some fee savings, I know that the intention was good, but at the end of the day, end up exacerbating some of the diversification within the portfolio. It ended up being that if one of those managers was not in the market to raise capital, it made it very difficult for staff to find a different manager, things of that nature. So I'd say to be thoughtful about the strategy that's being used in order to be able to identify and become strong partners with the best managers that you have there. I'd say additionally, one that is taking place now, and that is to be thoughtful about looking to allocate the right amount of capital to the strongest managers. So heretofore, there had seemed to be, relatively tight ranges that the staff would use to think about as their quote unquote check size for deployment to particular managers. And I think now there is increased emphasis on trying to identify those managers that are the highest conviction and to try to deploy more capital with them and to think about doing more separate managed accounts for additional fee savings and focus on them for co-investments. So I think that an additional focus on those managers that you can have the highest conviction with is also helpful. So I think all of these are going to be developed and thought about within the strategic planning process that's undergoing now. But I can see some aspects of these are being deployed today.
Thank you. That was very helpful. You spoke of the need to focus on those managers that are having the highest returns. How do we do that while also preserving the diversification of our portfolio, which seems to be a critical part of success for an entity the size of CalPERS?
Yeah, absolutely true, and it's a key tension within the portfolio construction that staff puts together. So being able to access the allocation with these strong managers takes time and attention and effort to make that happen. So I think that the additional efforts on developing the partnerships and knowing that to the manager that CalPERS will be a consistent partner for them is important to get that access. Right now, a lot of the analysis that's done to try to assess whether it's a high conviction manager has to do with looking at the prior track record and seeing how that has performed, as well as the skills and capabilities of the team. But those tend to evolve over time as different strategies develop, but also these private equity firms are organic beasts, and that certain partners that are strong some years, as they develop, they may move to more senior and operating level positions as opposed to deal people, and so that needs to be managed. I'd say that at the end of the day, one really needs to think through from a bottom-up perspective what is the quality of the managers from the performance and the team and the strategy perspective, and then apply some of those top-down views to see, are we getting enough exposure in Europe? Are we getting enough exposure in growth equities? Are we getting enough exposure? Can we get anything in early stage venture capital? To try to build those sets of exposures within the portfolio. Some of them are a little bit easier to do at scale that CalPERS has, because for some of these things, having scale is really helpful. And for other strategies, other exposures, having scale is really, really difficult, because in order to get a meaningful exposure, it's hard to actually deploy the capital in that way, but and get that into the portfolio. That being said, all these are being thought through and considered as the staff is putting together the portfolio. But at the end of the day, if you don't have the access to the top managers through the development of relationships, you're not going to be able to have that choice about how that portfolio gets constructed.
Thank you, sir.
Thank you, Ms. Middleton. Mr. Jones.
Mr. Hart answered my question in response to Ms. Middleton, and I don't know how to delete my question on the chat.
That's okay. That's okay. We'll move on to Mr. Miller.
Okay.
Oh, I was going to say just about the same thing. My questions have been answered. Ms. Middleton's questions were certainly more succinct than I would have been able to manage, but I have no further questions.
Okay, great. It looks like we, excuse me, for item 8. Oh, we're not there yet. Never mind. So let's move on to the real assets.
Great. This is Christy Fields, Madam Chair, members of the Investment Committee and the board. I will make some brief comments about real assets. It's always a little bit hard to be the rear guard here on long days like this, but I will try and provide just a few kind of high-level comments on the real assets program. I would like to start with a comment that applies to the total fund as much as it does to the real assets program, and that is about the turnover in fairly senior positions. And while the organization is lucky to have some very deeply experienced and long tenured professionals who have stepped into some of these other positions, I think it's worth recognizing that these are very different jobs in some ways, very big jobs, and that some patience and support is, merited here. Sarah Core is in the transition to the MID job for real assets. She's getting up to speed very quickly. That said, it's a very large portfolio, and it will certainly take some additional time for her to develop a truly granular understanding of all the holdings. Her transition, though, has been facilitated, thankfully, by a very stable and experienced staff beneath her. And so that's been great in easing the transition, as has the strength of the processes that have been put in place over the last 5 to 6 years under Paul Machaka. David, Lisa, and I are consistently impressed with the data collection, the data analysis, and then the investment insights that are developed by the team on a regular basis and shared through kind of the Real Asset Investment Committee meetings. COVID certainly has had an impact on the real estate portfolio. And there are certain points of pain for sure in the retail segment, in the transportation segment to some degree. But in general, everything the portfolio is generally in control. The staff has a good handle on the exposures and the concentrations, very good communication between staff and your long-term strategic partners. And indeed, the business model that was put in place in 2011 and then ratified again in 2016 is really proving its mettle. Just to refresh everyone, these are kind of a relatively small handful of large separate accounts with generally relatively low leverage and high alignment of interests. They're fee efficient, they're scalable, and they've really allowed staff to have a very close control of this portfolio. So that's important not only in times like this where there's some stress, but also going forward when there may be significant opportunity to place additional capital. On the performance front, I would just highlight, and this was highlighted earlier, but I think the performance of the core portfolio, and then even within that, the performance of the income return continues to be very strong in the real assets portfolio. And that is delivering on the primary objectives for the portfolio, which are the delivery of long-term income and with which you can pay your benefits, diversification from listed securities, and then a hedge against inflation. If we look at the income return over the last 10 years, all time periods really exceeded 4% annually. And if you look at the 10-year T-note now at 66 basis points, you can see the value proposition that this portfolio brings. The last point I'll make is that valuations are still quite murky in all real assets, just given the low levels of transaction activity. We expect some changes to value. We don't have a lot of visibility around that. Some of it will depend on behavior changes and how we interact with the built environment longer term based on our experience with the pandemic. Some of it will depend on how much future growth rates of rent will be impacted by the pandemic and the return to using space in somewhat more normal fashions. On the other side of that, we have very low interest rates, and that goes a long way, along with the weight of capital in the market, to supporting more robust valuations. So those are all things that we're continuing to monitor, both for your portfolio and for the larger market. So with that, we believe that your real estate holdings are in good shape, and that they will continue to provide relative value for you over the long term. With that, I will pause and take questions if there are any.
Thanks, Chrissy. Wow. I have a bit of an echo. Henry?
You calling on me? Okay, you can hear me? I'm hearing a feedback or something. Am I coming through clearly?
Yeah.
Oh, okay. I don't know what it is. It's something. Anyway, my question goes to towards the end. You talk about some weaknesses, some opportunities, and some threats to the real estate portfolio. And on the threats, you have COVID-19 and some of the others, but you don't make reference to climate change. Why?
It's a good point. We are trying, certainly climate will impact the real estate portfolio. And as was mentioned earlier, real assets, this was the first year that they were able to do their carbon footprint, and there are ongoing efforts to try and create some baseline metrics that we can use over time to make to get more insights about how impacted your portfolio might be and what that might mean for portfolio construction decisions and ongoing portfolio management. Y'all are early movers with a lot of the tools that are available currently. That said, a lot of these tools are evolving, and I think we'll continue to bring more value from a decision-making perspective over time. But you're right, that was probably an oversight for us not to mention it at all. Thank you.
Okay.
Okay, that seems to be it. If we want to move on to, what was it? Oh, what's our next? Infrastructure.
Madam Chair, I think Ms. Shields was speaking to all of Makita's thoughts on real assets, although
okay,
please correct me if I'm mistaken.
That's correct. Thank you. Sorry, I wasn't clear about that.
Sorry about that. It looks like then we are done with 6B, so we should move on to 6C, the review of survey results of board investment consultants.
Thank you, Madam Chair. Jared, if we could please move Kristen Lamatia forward from the attendee room to the panelist room. And then once that's done, we can move Christy Fields and Steve Hart back to the attendee room. And I'll leave it to Ms. Lamatia to walk us through this.
Kristen should be on and able to share her audio and video, and I'll move everybody else out.
Perfect. There she is. Thanks, Jared.
Hey.
Kristen, over to you.
Thank you. Good afternoon, Madam Chair and committee members. Kristen Lamantia, CalPERS team member. I'm here today to go over the annual evaluation survey results of your board investment consultants. As shown in the agenda item, the Enterprise Strategy and Performance Division, or ESPD, acts as a neutral third-party administrator of the board investment consultant surveys. This year, the surveys were for the following consultant groups and asset classes: Wilshire Associates for general pension, Makita Investment Group for real estate, and Makita Investment Group private equity. The questions asked this year are the same as in previous years, and this year, 6 out of the 9 committee members responded to the survey questions. In your materials, the survey results for both 2019 and 2020 are displayed for comparison for both Wilshire Associates General Pension Investment and Makita Investment Group Private Equity. And since this is the first year that Makita is being rated for real estate, we've only displayed results for 2020. I would like to take a moment to highlight a survey calculation example. May I ask you to turn to slide 6 of the PowerPoint deck, which is Wilshire Associates question number 1. As a reminder, this year, 6 out of 9 committee members responded to this survey, and in 2019, we had 9 out of 13 committee members respond. I'd like to provide the committee member equivalent to the percentages you see listed here. So for question number 1, accurately analyzes issues and provides timely and objective information. The blue bar chart represents 2019. We had 56% or 5 committee members rate very satisfied, 33% or 3 committee members rated satisfied, and 11% or 1 committee member rated neutral. The gray bar chart represents 2020. We had 33% or 2 committee members rate very satisfied, 67% or 4 committee members rate satisfied, and 0 committee members rated neutral. When considering this specific question, this year, 90% of committee members who took the survey rated very satisfied or satisfied. Last year, the percentage was 89.
Can we overview this rather than go through each question?
Oh yeah, that was the only one I was going over.
Okay, great.
Yeah. The comprehensive results for all consultant group surveys are included in your materials in the form of charts representing the various answers selected by the participating committee members. And with that, I will pause and ask if there's any questions.
So I do have a question from David Miller.
David. There we go.
Yeah, I think probably time that we take a look at this survey a little more carefully from a design perspective and see if we think all these questions really serve our needs. The other thing that strikes me is, at least for the surveying the board, it might make more sense to just, in terms of deployment of this survey, rather than send it out and have less than half of us bother to reply, which leaves me wondering, did they just love everyone so much that they couldn't bring themselves to finish the survey and were, or what? But to maybe do it in person with each of us and just, walk through it and have us even do it in a conversational, go through each of the questions, annotate our results, and even provide an opportunity for more open-ended feedback versus this 6 out of 13, which leaves me unable to interpret what the board really thinks at all. And that's it.
Thank you.
Thank you, David. And I will agree. I think these questions sort of don't apply to our relationship with the board. And I know it's the same questions we've been asking for some years. I'm wondering if maybe we should put together, and that's a Henry question, some sort of working group to take a look at the questions and then take a look at how we can make sure we get fuller responses, more than just 6 or more than just however many, whatever that percentage is of the board investment committee members. So, and I did kind of opine on this, I think, a little bit before with our consultants as well, because I think, so for example, let me give you an example. Where'd it go? I'm losing it here. Recommends ways to control or reduce fees and costs. I'm not sure that they do that with us. Helps define appropriate risk parameters and identify mitigation strategies. I'm just not sure that these are reportable. I mean, with their fuller reports, we can ask these questions, of course, but I think it's important that we have better questions on what their actual scope of work is. That maybe, I believe that's in their contract, so maybe we can align those questions better with that. So I agree with David that maybe we should look at that. And Henry, that's up to you if you want to put together a working group on that.
Yeah, Chair Taylor, these questions have been patterned after the scope of work or the contract that, that sets expectations for all these independent consultants to go to the board. So it doesn't mean that we can't modify the questions if, these are not the questions that really demand the expectations or highlight the expectations that you have for your investment consultants. But we'd be happy to hear more about that. The other thing we could look at is, are we giving you enough lead time to complete this? This should be a fairly easy survey to go in and complete. Perhaps you need a little more lead time to do that. But happy to talk about a number of avenues to make this more in line with what you expect.
Yeah, Ms. Teller, yes, I will take this under advisement and see, working with staff and see what we could do. However, I was wondering about the 6 respondents out of 9, because this was intended to go to all 13 board members. So I was not aware that it only went to the investment committee members, because these are consultants to the whole board, as David indicated. So that's another piece we need to resolve, that even though they're not on the committee, it's still a consultant to the board, because they talk, they serve us all. And
That's true.
Yeah.
I agree.
Yeah.
Did you have an additional question, Henry?
No. I just wanted. That was going to be my comment about the 6 versus 9 members of the investment committee, and also I heard the comments, so we could take a look at what modifications may be appropriate.
Okay, thank you very much. And then Ms. Paquin?
Thank you, Madam Chair. So we also support taking a look at the questions to see if they're still the best type of feedback that we can get. And also like the idea of having open-ended questions. And then I think it would be helpful to ask the consultants to do a short overview of their work for the prior year to be sent out to the board along with
That's a good idea.
And just kind of, because sometimes they do work closely with staff and that doesn't always come through in the investment committee meetings. Thank you.
Right, but these are, I agree, Lynn, that, and I even thought about that. I was thinking, well, are these questions that they answer to the staff, but then why are we taking the survey, right?
I think it's just good for us all to have an understanding of what their interaction is with the staff, and then we can kind of base what we kind of feedback we get from them during the board meetings on what they've been doing in the background. So.
Right. Good idea. Okay. I think that was it on the board survey. If we want to move to 6B, and that's the long-term care.
All right. Thank you, Madam Chair. Yes, Jared, if we could please bring Dawn Molds, Eric Baggeson, and Christine Reese forward to the panelist group. And then Kristen, we can move back, Ms. Lamantia, back to the attendee group would be great.
Okay, we have our 3 presenters ready to come on screen.
Perfect. Thank you, Jared. And as you say, Ms. Taylor, this item is an update on the plan around the reviewing the asset allocation for the long-term care program. So with that, I'll turn it over to Dawn Molds to introduce the item, and we'll take it from there. Dawn, over to you.
Great. Good afternoon. Don Molds, Chief Health Director and CalPERS team member. I should, I guess, let everybody know first that I haven't inadvertently logged on to the wrong committee meeting. As all of you know, several CalPERS team members have been working on a solution for our long-term care program. That work extends across jurisdictions of 3 different board committees: the Investment Committee, the Finance and Administration Committee, and the Pension and Health Benefits Committee. Staff in all 3 of those branches have been meeting weekly to coordinate their work, and because we're all having discussions in 3 different committees today and tomorrow, we thought it would be helpful to do a little bit of front-end framing to clarify how those discussions fit together. I should note that all of the agenda items this month are informational, save for an item on the action consent agenda at FAC, where we're seeking authority to move forward with a request for proposals. Most of the items we're discussing at this board meeting will come back to you in November, where we'll be recommending action. Back in the spring, the team alerted you that CalPERS is facing the potential need to adjust actuarial assumptions in the model it uses to project future costs and to reduce the discount rate for the long-term care fund in light of recent return of the fixed income investments, which are the long-term care funds primarily holding. As I discussed in April and June, without additional action, such changes would unfortunately require significant premium increases. I'll remind you of what I reminded you of then, which is that the long-term care fund and its discount rate are totally separate from the CalPERS pension fund. The long-term care program is a closed fund, which means that additional revenue needed to meet any new liabilities must be generated from within the long-term care program. So let me go ahead and jump in and give you a snapshot of the discussions you're going to be hearing and how they fit together. In FAC, you're going to be getting a detailed account from the actuarial team of proposed updates to the model they use to determine future liabilities of the long-term care fund. These include changes to our assumptions about morbidity, which is the rate of disability among our long-term care population, mortality, which is the death rate among our population, lapse, which is the rate at which policyholders drop coverage and exit the program, and the discount rate, which is the rate at which we discount future liabilities based on investment returns. The projected updates to our assumptions about morbidity, mortality, and lapse are not insignificant, but it's the discount rate that's the primary driver of the potential need to raise rates. When FAC meets on Tuesday afternoon, Scott and his team are going to tell you that based on the work conducted by his team and validated by outside actuaries, they believe we need to adjust the discount rate from its current 5.25% down to about 4%. That's a significant drop, which, if not addressed, would create a shortfall in the long-term care program. To repeat what I said earlier, you're not going to be asked to adopt the proposed changes to the discount rate this month. Much of the work we've been doing internally is focused on solutions that would allow the board to adopt a more modest adjustment to the discount rate. There are essentially three ways of addressing shortfalls in the long-term care program. The first is by raising premiums. The second is through changes to benefit design. And the third is by taking steps to improve our investment returns. To be clear, reducing the amount we need to raise premiums is what we're trying to avoid doing here. I'll also add that we can't change the benefit design unilaterally. We're contractually obligated to provide the benefits our policyholders signed up for unless they voluntarily switch to different benefit structure. Nonetheless, we can offer them alternative benefit packages with lower actuarial value as a way of giving them the option of avoiding otherwise needed premium increases. The Health Branch team has been working with both our own actuaries and with outside consultants to explore possible new benefit design options and model them. I'm going to be talking with you about our current thinking with respect to alternative benefit structures at PHBC on Tuesday. As I said, the third way of addressing the shortfall in the long-term care program is by taking steps to improve our investment returns. This has been a major focus of the work the cross-branch team has engaged in over the summer. I'll say that we were initially pessimistic about the prospect of improving returns. The average age of an LTC beneficiary is 75, which means that the number of folks in the program are approaching the age at which they will start needing services. For the program, the start of services also marks the time when eligible program enrollees stop paying premiums and start drawing down on their policies. Our initial concern was that the near-term generation of new liabilities would really limit our ability to consider longer-term investment strategies. There are a couple of considerations that have generated some optimism, however. The first is that the modeling that takes into consideration the updated assumptions about morbidity, mortality, and lapse show us that even though there are significant near-term liabilities facing the long-term care fund, those liabilities don't hit their peak until 2039, so close to 20 years from now. That timeline opens up the possibility of some longer-term investment options. Second, the team spent much of the summer doing extensive research, working with 2 outside consultants and engaging national experts with experience in long-term care and other closed fund portfolio investing. The takeaway from that work is that we think that CalPERS can potentially improve their investment returns on their existing portfolio with its existing liability schedule without assuming inappropriate risk. You're going to hear more about that from the investment team in just a minute. All of this brings us to where we are today, which is to the 3 discussions you're going to be hearing in 3 committees, INVO, PHBC, and FAC. I'll apologize to you now that the order in which you're going to be hearing these discussions isn't linear, but the committee schedule sort of dictated that. Today, in the investment committee, you're going to be hearing from the INVO team about their plans to move forward with an RFP for specialized investment management help with the LTC fund. They're also going to be updating you on some of the key takeaways from the research we conducted over the summer and to update you on proposed changes to the management of the LTC fund going forward. Tomorrow morning at PHBC, I'm going to walk you through some of the options we've looked at on the benefit design side and outline an approach to offerings for members who want to buy down any potential benefit increase by taking up alternative benefit designs. Tomorrow afternoon, ACTO is going to walk the FAC committee through all of the modeling work they've done to identify current long-term care program liabilities. Two more things before I turn it over to the INVO team. First, a reminder that these three discussions I just went over will all be informational. In particular, it's important to be clear that we aren't asking you to adopt a discount rate or to memorialize program liabilities. What you're getting today is a snapshot of where we are if we take no action. Our hope is that come November, we will be recommending action, which will change the current discount rate and liability snapshots, and which will be a better scenario. And second, I want to again recognize that this is an exceedingly difficult time to be having this discussion. We live in difficult and uncertain times, and we deeply regret the extent to which this discussion adds to the anxieties facing our long-term care program beneficiaries. As I've said in the past, we are responding to multiple systemic issues facing the entire long-term care insurance sector. Our goal here is to mitigate the negative effects those challenges have on our policyholders. And with that, I'm going to turn it over to the investment team.
All right, thank you, Don. Can everyone hear me? Perfect. All right, good afternoon, Madam Chair and members of the committee. Christine Rees, CalPERS team member. As Don mentioned, I'm going to provide a brief review of some of the key research findings and plans to release a request for proposal, or RFP, for an investment manager to provide specialized services for the long-term care fund. The recommendation, as Don also mentioned, is part of the Finance and Administration Committee agenda. So during the last few years, as we've heard, the long-term return expectations for fixed income securities have dropped to historically low levels along with interest rates. The long-term care fund has a majority allocation to fixed income securities to keep volatility low. And this results in a long-term expected portfolio return of 4%, down from more than 5.25% in 2018 when we last did our asset allocation study. The health, actuarial, and investment offices have been conducting research with the outside consultants. These consultants have expertise in the long-term care industry. And through this process, we've identified investment managers that have significant experience with insurance companies, specific expertise with asset liability management for insurance-type funds, and quantitative investment models and strategies that are specifically geared for insurance-type funds. So a little bit of detail without getting into too much, the models that these managers utilize focus on asset liability management and can incorporate such factors as the expected liabilities, potential premium increases, expected investment returns, and cash flow matching to produce portfolio outcomes for evaluation. The asset classes that may be proposed by managers could include current asset classes such as equities and fixed income, as well as less liquid asset classes such as private equity and real estate, and possibly the use of leverage, some of the themes you've heard previously with regard to the PERF. In way of strategies, some of the strategies could include a buy and hold strategy for certain asset classes, dynamic asset allocation, and a risk-reducing glide path in future years, to provide just a few examples. As the sole sources of funding for the long-term care fund are policyholder premiums and investment returns, it is very important that we review all options and ideas that could be of benefit to the fund. Based on these research results, we're optimistic that releasing the RFP for the investment manager will result in custom-designed portfolio solutions and strategies that may increase returns for the fund while maintaining an appropriate level of risk. We anticipate that the results of the RFP and a recommendation for the strategic asset allocation and investment manager to be presented in November at the investment committee for review and approval, as well as at the Finance and Administration Committee for approval of the external manager fees. So I'm keeping my remarks brief. This concludes my remarks, and I'm happy to take any questions. Thank you.
doesn't appear I have any questions. Anybody, just before I go? Ah, Ms. Brown. I don't see you, but okay.
Sorry. Yeah, thank you. So, up until this time, our staff, internal staff has been managing and doing the asset allocation for the long-term care fund. Is that correct?
Yes, that is correct.
Okay. So it feels like we're kind of doing the opposite. It's like, we're trying to get rid of managers and reduce the cost so we can make more money, right? And not give it away to managers. And now we're kind of doing the opposite with the long-term care fund. And it doesn't seem to make sense. I heard your explanation. Can you share with us what they think they're going to get? I mean, because the problem is, unless we get an agreement, like when we heard the gentleman who ran the Japan fund, and basically, unless the manager produced beta, all they got was the regular fee. They didn't get a bonus, or they didn't get their higher fee. And so, that's my concern. We're going to end up spending more money because we're going to be sold a bill of goods, and we're going to believe what they say because we want to believe it, and we want to get higher returns for the long-term care. And we're going to end up paying more and getting no bang for our buck. And that's my concern.
Yeah, a couple of things that I'd like to mention. The long-term care fund is currently externally managed. However, we do retain the asset allocation work in-house. This particular fund is highly specialized, and we are in a position to where we really think that we would benefit from learning from the incremental expertise that these managers have, specifically in the insurance fund arena. So there are a lot of unique characteristics about this particular fund that are different from a pension fund, which is the large majority of what we typically manage. As well, this fund is a $5 billion fund. So if we were to look into, say, private equity or real estate, it would be difficult for us to manage those types of investments in-house. So it would be a more straightforward implementation. There will obviously be fees associated with that. But if we look at we're going to look at what all of the managers have to offer and really select what we believe is the best combination of return, risk, as well as cost. So we're not looking to simply find the manager that provides the highest return regardless of cost.
Well, and again, it's not the highest return. It's the highest return they say they can get. That's not the same thing.
Agreed.
All right. Maybe Ms. Olivares has a comment.
So, Mr. Rubalcaba?
Thank you, Ms. Chair. I appreciate the presentation. Thank you. And I think I'm glad you answered. My question was related a little bit, but the answer is sort of the same. You mentioned in your presentation about the, the specialized investment consultant we want. You had mentioned as one of the possible strategies a glide path. That automatically tells you that it's very different from our defined benefit program, which is open-ended, long-term. The glide path is when there's an endpoint. And for example, like they do, I think it was in one of the reports, you have these target date funds where the date you're going to retire or that you're going to expire or use your benefits, right, to say it that way. So I think your answer actually was the question I was going to ask is, what are the outside skills that we don't have inside? And one of them is the outlook you have, whether a long-term versus like a day target fund when there's an end date. So I appreciate that. And also, if we can, I had a vote on lowering the discount rate. If we can vote on increasing the discount rate, expected return, that's a good thing because it puts less pressure on premium. So I think I have to commend staff for looking at a possible solutions, and I'm looking forward to seeing what the RFP looks like and looking forward to what the results are. And we all will have time to deliberate those results of the RFP and the scope of work. So I look forward to this. I know it's on your, what does it call it, information agenda, but looking forward to when it is an action item. Thank you.
Thank you.
Thank you, Mr. Woodward. That was one comment that I was going to make. Is we certainly are going to have, we will go through the RFP process and we will come up with a recommendation, but certainly this will be an action item before this committee in the future before we take any action.
Great. Thanks, Dan. It looks like that's it for questions. Let me make sure. Nope. Hey, Stacy.
Hi, I have a question. So I know that with long-term care, assisted living, and in-home supportive services are seeing significant annual increases in cost. I'm wondering if we also look at that from the investment side. So are we looking at those investment opportunities? And if so, what influence do we potentially have there?
I'm not certain I follow your question. Can you restate it?
So yeah, sure. There are two sides, and this happens with insurance companies, right? So let's talk about it from the insurance angle. There will be the investment office, right? And they will make investments, and many of them will invest in companies that provide in-home supportive services, or invest in real estate investment trusts that provide assisted living, because those are very profitable markets. I'm wondering if we coordinate with our investment office to take a look at those investment opportunities to better understand what those costs are going to be going forward and what investments we can make. And then thirdly, how we can kind of influence those costs.
So I can start just by saying that we periodically have conversations on the health side with our investment office over exactly these kinds of things. We have not had that conversation yet with respect to long-term care services, but I think it's a great idea. Would be happy to do it.
Thank you.
The only thing I would add to that, Ms. Oliver, your question around the investments, that's one of the reasons to go out with an RFP is to survey the marketplace and people with this insurance expertise to see if there are ways to align the liabilities with the assets more directly.
All right, thanks.
All right, great. That's the end of our questions. We do have two callers for the end of public comment, but right now it's summary of committee direction.
All right, thank you, Madam Chair. I have 4 items for committee direction, and I'll ask if there are others. But the 4 that I had was number 1, a description of the rationale for the exemptions. And for what it's worth, I guess there's actually a link on the CalPERS intranet site, but we'll make sure that we get that link out so that everybody can understand what those terms mean when we reference exemptions from competitive bid. The second one is for Ms. Ann Simpson to come back with a climate change update in November, so we'll make sure that we get that agendized for the November agenda. The third was we had public comment from Mr. Gerling and Mr. Garvey, and we will reach out to them and try to get their questions answered. And then the fourth thing that we had was to try to get consistency between the CAFR and the investment office reporting around kind of the naming conventions for some of the managers and strategies. And those are the 4 directions that I had. I'll ask Arnie or Ms. Taylor if you had anything that I was missing.
I don't think so. Arnie, did you have anything?
Nope, not on this side either.
Okay. No, that all looks good. So we still have closed session. I'm going to move into public comments. Mr. Fox.
Yes, Madam Chair. Back on item 6D, you have 2 callers specifically for that subject. First caller, J.J. Jelensik.
Hello. The trust documents
say that the board is in charge of the administration of the system and the investment of trust funds. A key to investing is to define the level of risk to be undertaken. No fiduciary responsibility is more fundamental than determining the risk appetite of the fund. You have just been told that your agents are going to contract out the job of defining your risk appetite. Your agents have just told you that they're going to contract out the identification of the asset allocation that reflects your risk appetite. Your agents have just told you that they will contract out the investment management of the fund. They have also told you that they are far enough along with defining your risk appetite, the asset allocation reflecting that appetite, the manager to make those decisions, and to manage the fund will be reported to you by next month. You are rapidly earning the nickname Board of Standbyers. Thank you.
Mr. Fox, the next one.
Yeah, just a moment, Madam Chair. Tim Behrens is trying to get into the queue here. So I have Tim Behrens and then Larry Woodson.
Thank you, Madam Chair, members of the committee, Tim Behrens, California State Retirees. CSR is very concerned about the sustainability of the long-term care program. We do agree that efforts to increase investment returns are needed and that review of current asset allocation strategies and investment management is in order. However, we do have concerns regarding hiring an outside manager at a cost of over $1 million annually to perform what hopefully CalPERS investment professionals could do themselves. If given the direction of reviewing and altering asset management strategy and making new investments, it seems staff could perform this at a savings of over $1 million annually. In the benefit and risk analysis staff presents, only the risks from not conducting an RFP search are listed. It seems there should also be a listing of risks associated with hiring an outside firm. Thank you.
Thank you, Mr. Behrens. Mr. Fox, the next person.
Yes, this is Larry Woodson, California State Retirees, and thank you for the opportunity to comment. I will comment later on the discount rate reduction proposal, which will be discussed tomorrow. As chair of the Health Benefits Committee, I and my committee members have heard concerns from our members for a number of years now about that have the LTC program about the increased premiums and less benefits. And so I do applaud Dr. Moles and his team's efforts to address the issues and ensure sustainability of the program. And I also agree with Mr. Behrens that the risks identified in the write-up are only for not letting the RFP, and there are risks associated with hiring the external manager. So, and maybe I could mention a couple of those. I mean, there is it kind of runs counter to CalPERS with the PERF funds trying to reduce outside managers. I think they've reduced them by over 100. And the other thing is I've just heard that, you know, and to their credit, CalPERS has already done a lot of consultation and has made some conclusions, drawn some conclusions about the opportunity for longer term investments. Of course, I think we're concerned about the short term too, particularly there was no mention of a lawsuit, and that could throw the whole thing into a tither. But also, assuming a new asset allocation would decrease investment in low-risk fixed income assets, which have the fund has 67% in fixed income. I'm assuming a lot of that would be changed into other instruments, which would be higher risk. And there's just the economy's on such shaky ground now that it could result in major loss in the short term rather than gain. And my last comment is an observation, which is puzzling to me. The long-term care invests 67% of its fixed income in fixed income investments, the long-term care fund, and the latest total returns were 4%. And yet for the PERF, fixed investments, the fixed income was the highest return at 12.5%. And even last year was 9.5%. So I'm not sure why the disparity. So I guess in conclusion, we don't completely oppose, letting out an RFP, but have a lot of concerns with it and hope the board will scrutinize it and consider the risks associated with it, and maybe save us over $1 million a year by letting our
Thank
own
you, Mr. Woodson. Thank you, Mr. Woodson.
Thank you.
Mr. Fox, can you go ahead and get the next question?
Yes, Madam Chair. That concludes the conversations regarding item 6D. The next 10 callers will all be on public comment related to fossil fuels. I'll begin. I'll start and ask each one of the callers to please introduce themselves.
In the effort of making sure that we are conserving our time, because we still have a whole closed session to go through, I would ask that our public commenters, if you're repeating somebody else's words, don't do that. Just make you, if you can make separate comments, that's great. But if you think you can combine the comments together, that would also be great. Appreciate it. Thank you.
Go ahead, Mr. Filling.
Good afternoon. My name is Stephen Filling. I have been blessed to teach accounting at CSU Stanislaus for the last quarter of a century. In the pellucid phrases of Governor Newsom, we're in a climate dam emergency, an emergency driven by climate change, driven in turn by burning coal. A report issued today by the Fossil-Free California Group calls into question CalPERS compliance with SB 185 rule sets. I'm requesting that the board seek a review of 185 compliance efforts. Furthermore, I suggest that perhaps in line with the spirit of SB 185, you consider examining performance on this through the lens of the global coal exit lists rather than waiting for the legislature to issue further direction. On financial matters, it's far from clear that thermal coal company investments will retain value, let alone generate return. We know that returns on fossil fuel investments are lower than other sectors, and given the global push to reduce fossil fuel use, I don't see any reason for optimism. A little while ago, Ms. Field referred to CalPERS as having a reputation as early movers. I encourage us to live up to that reputation and move early and quickly out of the coal industry. Thank you for listening.
Next caller. Go ahead, Ms. Kaufman.
Oh, hi. Thank you. I didn't know I was next. So thank you so much for taking the time to listen to me. And I just wanted to say that according to the recent report called CalPERS Continues Investing in Coal, CalPERS owns $5 billion in the companies which are on the global coal exit list and $1.46 billion in the top 100 coal companies. CalPERS has not been an early adopter and an early leader in this. You're really lagging behind. Being in these companies is incredibly risky because market forces and public policy will bring these companies down and will lose money for the fund. As their assets become stranded. We would like for you to completely divest from fossil fuels, and we know that selling shares in itself is not significant as other buyers will buy those shares, but doing so will send a dramatic message which has been proven to lead to political tipping points. Please inform yourselves and read the article from January of this year in the Proceedings of the National Academy of Sciences called Social Tipping Dynamics, which explains how divesting from fossil fuels from an institution such as yours, which is quite large, will have dramatic impacts on shifting the way coal companies are allowed to operate, and will have a huge impact. You guys are in an incredibly powerful position to make a tremendous difference in stopping the problem of climate change, which is causing such a disaster for all of us right now. Thank you so much.
Next, please.
All right, next we have Ms. Thorne.
My name is Sheila Thorne. I'm a CalPERS beneficiary and a retired member of CFA. And I'm very concerned by the decisions to add billions in coal and coal-related holdings in recent years, holdings that are on the global coal exit list, as revealed in the CalPERS report, continues to invest in coal report. I think these investments are both ethically and fiduciarily irresponsible. For example, Duke Energy, the largest of these holdings, was convicted in 2015 of 9 federal environmental crimes for allowing coal ash dump sites in North Carolina to leak toxic waste into water supplies. Last year, Duke Energy admitted that it has continued to pollute drinking water with mercury, barium, lithium, radium-226, and radium-228. Higher rates of cancer, especially thyroid cancer, have occurred in the small North Carolina communities near Duke Energy plants. In 2017, Duke Energy was the nation's worst emitter at 104.6 million tons of CO2 emissions. In southwestern Indiana, where its Gibson plant was declared a super polluter, 1,674 people went to emergency rooms with asthma attacks in 1 year. Coal kills. Many communities around power plants are low income and of color. The cost of Duke Energy's forced toxic coal ash cleanup is estimated to climb to $10 billion in the coming years, and that does not include all the litigation costs. Carbon Tracker found that 89% of Duke's coal fleet has a negative profitability rate, and 96% could have negative profitability by 2030. There will be no long-term returns on coal. Duke Energy makes empty promises to become net zero by 2050, but a Sierra Club report reveals that they still plan to keep coal plants online until as late as 2048 and operate roughly 9 gigawatts of coal into 2030. Meanwhile, apocalyptic firestorms, the result of global warming, are raging around us. Frankly, I'm terrified. How can you continue investment? How can you justify continued investment in the coal chain? Thank you.
Thank you. Next, Mr. Fox.
We have next Sarah Thies.
Hi, my name is Sarah Thies. I'm a member of Fossil Free California and a CalPERS retiree. Ms. Frost's letter to me yesterday is apparently CalPERS' response to our coal report, as well as to 3 letters to you about CalPERS coal holdings that we've sent over the past 3 months. The letter describes CalPERS' theory of change as to the climate catastrophe, which involved shareholder engagement, advocacy, and integration. Obviously, Fossil Free California has a different theory of change. But Ms. Frost's letter does not at all address the content of the coal report we released today, which is focused on coal as an investment and the problems with CalPERS coal policies. My comment focuses on the fact that CalPERS stayed invested in 3 companies under SB 185 that still make over 50% of their revenue from thermal coal. One of them, Exaro, plans to expand its operation sixfold, yet CalPERS more than doubled its investments in Exaro. Did the board decide to make these additional investments in Exaro in a closed session? If not, did staff make this decision without board approval? And given the failure to even begin to meaningfully transfer to cleaner energy over the past 5 years, shouldn't CalPERS just divest from these three companies following the language and intent of SB 185? Ms. Frost's letter states that the board will review its SB 185 coal divestments next year. We believe that beneficiaries, the legislature, and the public deserve answers before that. This is especially so given that many investors are fleeing coal and the value of the sector is declining precipitously compared to the rest of the S&P 500. Fossil Free California therefore requests that, consistent with SB 185, the board instructs staff to sell its thermal coal assets consistent with 185, SB 185. We also strongly urge the board to do a full review of all its coal industry investments using a process consistent with its fiduciary duty. We believe such a review will demonstrate the long and short-term risks to the fund from the coal industry. When there's a sell-off in shares, as is occurring now in much of the coal market, they tend to decline in value. Risky investments should become someone else's problem. Why force our retirees to continue to shoulder this burden? The time to begin a process of divesting from the total coal value chain is now. Thank you.
Thank you. Next.
We have Dr. Gould.
Hi, can you hear me? Hello? Can you hear me?
Yes.
Yes.
Okay. Hi, I'm Dr. Robert Gould. I'm a retired Kaiser pathologist, a UCSF professor, and president of the San Francisco Bay Area Physicians for Social Responsibility. Representing thousands of California health professionals, PSR calls on CalPERS to swiftly and completely divest from fossil fuels and instead invest its vast financial holdings in renewable and sustainable non-nuclear energy portfolios that would better provide a future for CalPERS retirees by averting the catastrophic public and environmental health consequences of global warming that threaten all human civilization. The fourth National Climate Assessment warned us about the rapidly unfolding impacts of global warming that gravely threaten our health, including sea level rise with flooding and contamination of water systems, extreme weather events, and wildfires. Today, these climate-fueled catastrophes are determining the health and future of every Californian. Over 25 million people live near the sea, and coastal communities are already experiencing major flood events. Heat waves like those which just scorched our state are the #1 killer among climate-related exposures due to heat stroke, dehydration, and complications of chronic illnesses, including kidney, cardiovascular disease, and diabetes. The wildfire air pollution we are currently enduring is indelibly undermining the health of millions of Californians in real time. Recognizing such climate-caused health harms, the American Medical Association, American Nurses Association, and American Public Health Association have issued strong policy statements urging climate action, joined by resolutions from numerous health specialty societies, including the American Congress of Obstetrics and Gynecology, the American Academy of Pediatrics, the American College of Physicians, and many other members of the Medical Society Consortium on Climate and Health, representing 600,000 U.S. clinical practitioners. We health professionals recognize that divestment in fossil fuels is cost-effective, health-protective, preventative medicine. Since 2018, it has been the AMA's official policy quote to protect human health from the effects of climate change by ending its investments in fossil fuel companies, unquote. PSR urges CalPERS to speedily and completely divest from fossil fuels for the health and wealth of the people you serve. Thank you.
Madam Chair, next we have Ms. Sutton.
Hello, my name is Patrice Sutton. I'm a Californian, a public health professional, a collaborating research scientist at UC San Francisco, and a retiree. I'm also chair of the Environmental Health Committee of SFB Physicians for Social Responsibility. And on behalf of PSR, I'm asking CalPERS to stop investing in coal. Your continued investment in fossil fuels is fiscally irresponsible and threatens the health of California's workers, their families, their communities, and future generations. One need not look any further than out the window to see how the climate emergency is destroying our life support system. In California, heat waves are the new normal, and climate-fueled wildfires have poisoned our air. The science shows what's at stake from just these two climate-related exposures. Heat and air pollution are critical contributors to adverse pregnancy outcomes, including preterm birth, low birth weight, stillbirth, infertility, and miscarriage. Rising temperatures are also a direct threat to California's essential agricultural and other outdoor workers. The science demonstrates unequivocally that burning fossil fuels and its related climate impacts harms the health of the people you serve. Moreover, CalPERS investment in coal is antithetical to a vision for a healthy and just California, as its health harms are disproportionately felt by our state's most vulnerable populations. As such, your relentless investment in coal exacerbates instead of alleviates racial, environmental, and economic justice. Divestment is fiscally responsible. Had CalPERS divested from fossil fuels 10 years ago, it would have generated almost $12 billion more in value for its retirees. Your investment in fossil fuels has increased the vulnerability of your members to health and economic harm rather than secured their retirement, and has diminished rather than enhanced the fund. As health professionals, we strongly urge you to end financial support for all coal projects so retirees can reap the financial and health burdens of your actions, of your actions. Thank you.
Madam Chair, next we have Ms. Eide.
Hello, I'm a young Californian resident who spends every day fighting for my future because I'm terrified. CalPERS Investment Board, the state is burning. It is climate change, but I know you know that. You admit as much, but nonetheless, you don't act as if your house is on fire. Your engagement with high carbon emitting companies is risking our lives now. Your engagement plan, ironically, seeks to decarbonize companies that produce fossil fuels. Does that really work? Would you really want to live in a collapsing building in an evacuation zone? That's what you're doing. Coal is a collapsing industry, while fossil fuels are as a whole a dangerous endeavor with increasing volatility and little future. CalPERS Investment Board, I hope you, like me, has read and understood the IPCC 1.5 degrees Celsius report. It states that by 2030, we must be 80% done with coal completely, meaning not just investment, but usage. By 2040, that number has to be 100%. No coal usage, no coal investment, nothing. We would need to remove our money from coal. But instead, you've increased your investment by $1.5 billion. Your money speaks for you. You see a future in coal, even when climate and finance experts predict that it is in terminal decline. In addition, you insist that your engagement is sufficient. It's not. As Greta Thunberg accurately stated, our house is on fire. That doesn't mean long-term planning. That means immediate action. It means putting your money where your mouth is now, not in 30 years. CalPERS, I know you care more about your reputation than the climate. You panic when you hear about the report defending your reputation. The report on coal, you defend your reputation at a moment, but you don't engage in a discussion. And since then, you attend numerous sustainability panels and you profess your leadership in climate finance, but the fundamental argument you make is wrong. We don't have 20 or 30 years to reach a new sustainable model of operation. We have 12 years at the most. As a result, long discussions are not the solution. Investing in the technology and companies that offer solutions are not problems. That's the future. Invest in youth like me, the future, not the companies that pollute the water and air, causing my generation to fear for our lungs, health, and lives. Consider this. You're investing for our future, or are you investing for the present? Are you panicking about fossil-free California as CalPERS continues to invest in coal report because you care about your asses, or because you worry that we're right and you've made an investment error? For anyone listening, please check out an analysis of CalPERS' stupid coal investment decisions at bit.ly/CalPERScoal. Thank you.
Next.
Madam Chair, the next speaker, Ms. Ihara.
Is it working?
Yes.
Fires are devastating large parts of California. The higher summer temperatures as a result of climate change are a major contributing factor to the severity and frequency of these fires. Scientists argue that the fossil fuel use is responsible to a large degree for climate change. CalPERS must totally disinvest in the fossil fuel industry. It's shocking to hear that CalPERS has recently actually increased its investment in the coal industry. Board members, please act responsibly and insist to staff fossil fuel investments be eliminated within a very short period of time. This is Nancy Ihara, CalPERS pension plan recipient.
Next.
Madam Chair, Mr. Kawar.
Hi, my name is Faris Kawar. I've been a PERS member for nearly 10 years, and I'd like to know how CalPERS plans to make money on our investments in coal when the IPC scientists tell us that up to 78% of coal must be completely phased out in just the next 9 or 10 years. The demand for coal is shrinking every day for the following reasons. Hundreds of financial institutions representing trillions in capital have already begun to limit their exposure to the coal sector. Government policies restricting investments in fossil fuels are announced monthly, if not weekly. Cleaner fuel sources are competing head-to-head with no need for subsidies. And finally, pressure from climate campaigners are not going away. The voices are getting louder and stronger as we get closer to the 2030 deadline. I'm confused because this industry is in terminal decline, but you are investing as if you know something that the world's top scientists don't. Engagement is a great strategy.
I think we lost him.
Mr. Fox, can you check on the queue to make sure that the other speakers are still in and see what happened with this individual?
Marcy, I think the call-in studio call came off of the WebEx call. I don't see it listed here anymore, so I'll wait to hear from Kelly.
Okay.
They may have had a time limit on their WebEx at their end or something. Who knows?
Do we have anybody else up to speak? Can we move on by any chance? Or is the whole thing empty?
I think we should wait for just a few moments. I'm checking with Kelly. He doesn't appear to be.
15-minute break, and hopefully everything will be back up.
All right, sounds good.
All right. Let's see, it is, I can't read my clock. It's 6:50, 5 after 6. Let's be back. Thanks, everybody. With the rest of our commenters.
Yes, Madam Chair, we'll have 4 callers. We'll start with Sandy Emerson, then Ferris Kawar, Woody Hastings, and Dana Stokes in that order.
Okay, thank you.
Hi, I'm Sandy Emerson, and I'm the board president of Fossil Free California. I'm commenting on our report, CalPERS continues to invest in coal. As you know, SB 185, the intent was to remove investment. Hello?
You're on.
Thank you. Because of coal's outsized contribution to climate change, SB 185 was crafted in 2015 to require CalPERS and CalSTRS to divest from companies making 50% or more of their revenue from the mining of thermal coal. This is a very narrow definition. A 50% share is a very high bar. Many investors, including BlackRock and the state of New York, set a much lower threshold of 25% or even 10% thermal coal to qualify as a coal company. To really measure CalPERS investments in coal, though, you have to go beyond the definition of SB 185. Using the broader criteria of the Global Coal Exit List, an internationally recognized resource, CalPERS holds billions in coal, coal mining companies, coal-fired utilities, coal distribution and services, and large diversified companies with substantial coal operations. The volume of coal reserves represented by CalPERS investments is confirmed by comparing CalPERS holdings to the top coal companies listed by the Carbon Underground 200. Overall, CalPERS increased its investments in coal and coal-related companies by $1.5 billion between 2018 and 2019, for a total of $6.5 billion throughout the whole coal value chain. By failing to set a strong coal exclusion policy, CalPERS has already lost billions in absolute value on its coal investments, and the sector continues to decline. Recently, the New York State Common Retirement Fund divested from 22 thermal coal mining companies that, the controller said, are not prepared to thrive or even survive in the low-carbon economy. Why is CalPERS continuing to invest in this unprofitable and toxic industry? The IPCC says coal must be phased out entirely by 2050, and it's commonly held that at least 80% of coal reserves cannot be burned if we are to keep global warming below 2 degrees Celsius. For the sake of our pensions and our future, CalPERS must divest from coal. By staying invested and staying engaged, CalPERS continues to enable the coal industry to continue as a financial, health, and environmental risk. Thank you.
Mr. Kawar.
Thank you. I'm the gentleman whose comments were cut off, so thank you for allowing me to finish here. I was saying engagement is a great strategy, however, not for industries that are one-trick ponies, whose main product is a carbon-based fuel that needs to be burned to have value. These companies are making hollow commitments with no real plans or evidence that they're going to follow through. They will continue to string us along as long as we let them. Now, I understand that selling these assets will just mean some other unsavory investor will scoop them up. I say let them. When the markets hit an inversion point, anyone holding these investments will lose their shares. I mean, just think how quickly things can change with an election just 2 months away, and the entire West Coast of America choking on smoke from historic fires caused by a warming world. I hope your strategy is not just to wait until there's a critical mass of investors that are jumping ship. If so, my retirement income, as well as the beach I had hoped to retire on, just won't be there. Please reach deep, buck the conventional investment wisdom that has gotten us into this mess, and do what you know to be right. There are billions to be made reinvesting these fossil fuel dollars in clean energy and other sectors of the economy that are not damaging our health or our only home. Thank you very much.
Madam Chair, Mr. Woody Hastings.
Good evening, Woody Hastings. Can you hear me?
Yes, sir.
Can you hear me? Hello?
Yes, sir. Go ahead.
Okay, thank you. Good afternoon. My name is Woody Hastings, Energy Program Manager with the Climate Center, a statewide 501c3 nonprofit working for rapid greenhouse gas reductions at scale starting in California. Thank you for the opportunity to comment. In 2020, with the consequences of the global climate crisis already bearing down on us with unprecedented wildfires and other anomalous climate-related problems, it's unconscionable that CalPERS is doing this disservice to its beneficiaries by continuing to invest in coal. Coal is responsible for 44% of global carbon dioxide emissions, making coal the primary contributor to the climate crisis. CalPERS has $6.5 billion invested in coal and has been increasing its investments, while the investment is losing money. Given the state and global economic and policy trends, this sector is a very bad bet for a long-term investor such as CalPERS. Had CalPERS divested from fossil fuels 10 years ago, it would have generated an estimated additional $11.9 billion in value for its retirees. The returns on fossil fuel investments are lower than other sectors, and given the global push to decarbonize our energy and transportation sectors, there is no reason to believe they will be more profitable. An argument cannot even be made that these investments help the workers in the California coal industry because there is no California coal industry. California has a policy goal of a fully decarbonized economy by 2045. The Climate Center finds that this goal, though laudable, is not aligned with the imperatives of the latest science. We need to accelerate the timeline for phasing out fossil fuels, and CalPERS can and must be a part of this transition. We urge you to divest from your investments in coal. Thank you.
Madam Chair, we have Dana Stokes.
Go ahead.
I am a CalPERS pension recipient and a Fossil Free California volunteer activist. In September 2019, Governor Gavin Newsom signed a landmark executive order to leverage the state's $700 billion pension investment portfolio and assets to advance California's climate leadership. While the first climate risk assessment report by the investment committee and its consultants is important information to have, I would like to see CalPERS develop and produce for public viewing a companion assessment of its investments that are actively supporting Newsom's executive order. that are advancing California's climate leadership in real ways, real active ways, such as investments in renewable energy technologies, residential and commercial retrofits, smart metering and smart monitoring, etc. It's just as important for us, the pension holders, to be seeing what you are doing to counteract what you're not doing in terms of divesting from fossil fuels. So I very much encourage you to produce that information and to go even further than that, to really support Newsom's executive order to begin an actual transition actively of fossil fuel investments to their counter elements, which would be greenhouse gas emission reducing investments. Thank you very much.
Madam Chair, Mr. Todd Snyder.
Okay, thank you.
Good evening. My name is Todd Snyder, and I'm a concerned individual who lives in San Francisco, and I'm calling tonight to urge CalPERS to divest fully from what I call merchants of death. So 5 years ago, Senate Bill 185 passed the state legislature. It required you to divest completely from coal. It's now 5 years later. Why have you continuously failed to comply with state law? And as your fiduciary responsibility to the stakeholders in our pension system, why would you continuously invest in funds that are among the worst performers and among the most toxic externalities in our economy? Who is paying for the sick child with asthma in the emergency room? Who is paying for COVID morbidity that increases with every emission of greenhouse gas in our world? Who pays for your investment in coal stocks, which, by the way, are money losers and some of the worst performing stocks, I might add? So I encourage you to comply with state law, eliminate any and all holdings in the public employees retirement system in any form of coal, and think of your responsibility to the people who are going to have to live out the consequences of your decisions. Climate change is here, it's happening now, and you're sinking money into death. You have a responsibility as people whom we entrust with our money to ensure that it is invested in a socially responsible way. Do your job, divest from coal now.
Okay, Madam Chair, that completes all the callers. We do have one request for a previous caller to speak on someone else's behalf. I'll let you rule on that.
No. I think we get what the whole thing is, and I appreciate this previous caller speaking on someone's behalf, but I get what everyone is saying, and I will say, I think we all feel the import of this. We all are living in this state. We know it's an important topic. Ms. Simpson will be giving us an update in November. which will give us all a little more context and allow us to ask more questions and dig a little deeper into the Prop 185 and whether, you know, we're complying and the compliance of Prop 185. With that, I'm going to end the open session and we will move over into closed session. I give us about 5 minutes, I guess, because everybody has to disconnect and reconnect. I will meet you on the other side. Thank you. Open session is closed. Thank you.